Welcome to Wealth Building Fundamentals. We're launching this practical series to explore the timeless, foundational principles of building sustainable wealth. Our goal is simple: to distill core concepts into clear, actionable guidance. Over the next 11 episodes, we'll cover everything from compounding and leverage to emotional discipline and value creation. To begin, I want you to consider a question. What is the single most powerful force for wealth creation? It isn't a hot stock tip, a complex trading algorithm, or even a revolutionary new technology. It's a principle so fundamental that it governs everything from the growth of a forest to the accumulation of a fortune. Yet its true power is often overlooked because of its quiet, almost invisible nature. Today, we're exploring that force: compounding. We'll break down what it is, why its mathematical certainty is so potent, the psychological traps that cause most people to abandon it, and how you can harness it as the primary engine for your own financial growth.
Exactly. Think of compounding as a positive feedback loop. It's the process where the returns your investments generate are reinvested to generate their own returns. It's a beautifully simple concept. Your money starts working for you, and then the money that money earns also starts working for you. This creates an exponential growth curve. In the beginning, the progress feels almost painfully slow. The first few years, the gains are modest, almost insignificant. But as the principal amount grows, the returns it generates also grow, and the process begins to accelerate. The curve steepens, and the growth becomes explosive. This is why the most critical variable in the compounding equation isn't the rate of return, but time. The power isn't in earning a spectacular return in 1 year, it's in earning a good, consistent return over many, many years. The final years of a long investment horizon are where the majority of the wealth is actually created. This is the mathematical reality behind the old adage, time in the market beats timing the market. Trying to jump in and out to catch the peaks and avoid the troughs is a fool's errand. You risk missing the best days, which dramatically impacts long-term returns, and you interrupt the compounding process. There is no better real-world illustration of this than Warren Buffett. He is often lauded for his investing genius, and rightly so, but his real secret weapon has always been his incredibly long time horizon. He bought his first stock at age 11. But the truly staggering fact is that an overwhelming majority, somewhere between 95% and 99% of his massive net worth was accumulated after his 65th birthday. Let that sink in. Decades of diligent investing created a solid base, but the truly mind-boggling wealth, the hockey stick part of the growth curve, happened in the final stretch. His life is a masterclass in the power of patience and letting the math of compounding do the heavy lifting.
Buffett himself uses a wonderful analogy to describe this. He says, "My life has been a product of compound interest." He likens it to a snowball. Imagine a small, hand-packed snowball at the top of a very, very long snow-covered hill. When you give it that first push, it rolls slowly. With each rotation, it picks up just a little more snow. It's barely growing. For a long time, its progress seems trivial. You might even wonder if it's working at all. This is the flat part of the compounding curve, the first 10 or even 20 years of investing. But if the hill is long enough, if you give it enough time, that snowball continues to roll. As it gets bigger, its surface area increases. Now, with each rotation, it picks up a significant amount of new snow. Soon, it's not just growing, it's accelerating. It's gathering more snow with each turn than it did in the entire first section of its journey. In its final descent down the hill, it becomes an avalanche, its size and speed growing exponentially. That's compounding. The small, early deposits of snow are the initial investments. The growing size of the snowball is the principal plus the reinvested returns. And the very long hill, that is the unwavering, uninterrupted passage of time, the most crucial ingredient of all. Buffett's fortune is not the result of a few lucky rolls of a small snowball. It's the inevitable outcome of one snowball rolling down an incredibly long hill. That analogy perfectly captures the psychological challenge, though. Most people lose patience on that first flat part of the hill. They watch their small snowball roll for a few years, see that it hasn't grown into a boulder, and get discouraged. They think the system is broken or that it's not working for them. This is where the temptation to abandon the plan sets in. They start looking for a steeper hill, chasing riskier, speculative bets, hoping to speed up the process. Or they see the snowball hit a patch of dirt, a market downturn, and lose a bit of snow, so they panic, pick it up, and wait for a safer time to start again. Every one of those actions is devastating because it interrupts the compounding chain. Picking up the snowball, even for a moment, resets its momentum. You don't just pause the growth, you force it to start over from a smaller base. This is the danger of emotional decision-making. Panic selling during a crash or greedily chasing a hot trend are the two primary ways investors break the compounding machine. The key is to never interrupt it unnecessarily. There's also a more technical danger here, which is volatility drag. The math of compounding is severely impacted by large losses. A 50% loss requires a 100% gain just to get back to even. Think about that. If your $100,000 portfolio drops to $50,000, you need to double your money just to break even. Those kinds of deep drawdowns are like hitting a massive rock on the hillside. They can permanently impair the growth trajectory of your snowball. It's not just about earning returns, it's about preserving the capital base from which those returns compound. Protecting against catastrophic loss is just as important as generating gains.
That brings us to how we apply this principle in a practical, systematic way. The single most important step is to start now. Not tomorrow, not next year. Today. The time you lose by waiting is the most valuable asset you have, and you can never get it back. The amount you start with is far less important than the time you give it to grow. Second, automate the entire process. This is crucial for removing emotion and friction from the equation. Set up automatic monthly contributions to your investment accounts. When you receive dividends or interest, ensure they are automatically reinvested back into the fund. The goal is to create a system that works in the background, continuously and relentlessly, without requiring your constant attention or intervention. This protects you from your own worst behavioral impulses. For most people, the best tool for this is a portfolio of low-cost, broad market index funds. Warren Buffett himself has long recommended this approach for the average investor. These funds provide instant diversification, which helps protect against the risk of a single company failing. More importantly, their low fees, the friction that can slow your snowball down, ensure that more of your money is being put to work for you. By automating your investments into these funds, you create a simple, effective, and behaviorally sound engine for compounding wealth over decades. The final piece of the puzzle is periodic rebalancing, where you trim asset classes that have grown disproportionately large and reallocate to those that have shrunk. This enforces a buy low, sell high discipline and helps manage risk, preventing any single part of your portfolio from becoming so large that a downturn could cause a catastrophic loss.
It really all comes down to a fundamental shift in perspective. Building wealth through compounding isn't an active, high-octane endeavor. It's a passive, patient one. The goal is not to find the needle in the haystack. It's to buy the whole haystack and let it grow. Your job isn't to be a market timing genius. It's to be a disciplined, consistent contributor and to get out of your own way. You build the engine, you turn it on, and you let it run for as long as possible. The real magic happens when you do nothing.
That's the key takeaway. Compounding is the universal law of wealth creation. It is a slow, steady, and unstoppable force, but only if you allow it to work. Its power is backloaded, meaning the greatest rewards come to those with the longest horizons and the most emotional discipline. By starting early, automating your process, keeping costs low, and, most importantly, staying the course through market cycles, you align yourself with this powerful mathematical principle. It is the bedrock upon which all other wealth-building strategies are built.
And building upon that bedrock is exactly what we'll be doing in this series. Now that we've established the core engine of compounding, our next episode will explore how to add fuel to that fire. We'll be discussing the concept of leverage, the strategic use of capital, people, code, and media to amplify your outputs and dramatically accelerate the wealth-building process. It's the next logical step in our journey, and we hope you'll join us. Welcome to Wealth Building Fundamentals, In our last discussion, we explored the incredible, almost magical power of compounding, the engine that allows wealth to grow exponentially over very long periods. It's a strategy of patience, of letting time do the heavy lifting. But this raises a critical question. What if we want to accelerate the process? How can we amplify our efforts and decisions to achieve outsized results in a shorter time frame?
That's the central dilemma, isn't it? Time is the key ingredient for compounding, but we all have a finite amount of it. The answer lies in one of the most powerful and potentially dangerous concepts in finance and business. Today, we're dissecting the principle of leverage. We'll explore what it truly is, far beyond simple debt, by examining its different forms: financial capital, human capital in the form of people, and the modern, almost frictionless leverage of code and media. We'll look at why it's the force behind some of the greatest wealth creation stories and, crucially, how to wield it without getting burned by the immense risks it introduces.
Exactly. Understanding leverage is about understanding multipliers. It's about how to get a 10x or 100x output from a 1x input. While our previous conversation on compounding focused on the length of the runway, today is about increasing the upward slope of that runway. These two concepts work together to create truly remarkable financial outcomes. So let's start with the foundational idea. When most people hear the word leverage, they immediately think of debt. But the concept is much broader, much more fundamental.
It is. At its core, leverage is simply the use of a tool to amplify your own abilities. Think of a simple crowbar. It allows one person to move a boulder that would be impossible to budge with their bare hands. In the world of wealth creation, we're not using physical tools, but strategic ones. The four main types are capital, people, code, and media. The first two are forms of traditional or permissioned leverage. You need someone's permission to use them. Capital leverage means using other people's money, a bank loan, investor capital. You need the bank to say yes. People leverage means hiring a team to execute your vision. You need skilled individuals to agree to work for you. These have been the primary drivers of wealth for centuries.
And they both come with significant overhead and friction. A loan has interest payments, what we call the cost of carry. Managing people introduces complexity, communication challenges, and payroll expenses. They are powerful, but they are heavy tools to wield. This is where the modern forms of leverage come into play, which are fundamentally different.
They're a complete paradigm shift. The new forms of leverage are what you could call permissionless. They are code and media. Code, in the form of software, allows you to create a product or service that can be distributed to millions or even billions of people at virtually no additional cost for each new user. Once the software is written, it can be copied infinitely. You don't need anyone's permission to write a piece of software and put it on the internet. Media works the same way. A podcast, a YouTube channel, a blog, a social media account, these allow you to broadcast your ideas and insights to a global audience, again, with a marginal cost of replication that is practically zero. You don't need a publisher or a studio to grant you a deal anymore.
This distinction between permissioned and permissionless leverage is critical. The friction and cost associated with capital and people are what traditionally limited the speed of scaling. You had to grow incrementally. The near-zero marginal cost of code and media breaks that constraint, leading to the winner-take-most dynamics we see in the digital economy. It allows a small team, or even a single individual, to build something with massive scale and impact.
Let's make this more tangible with an analogy. Imagine you're a skilled baker. With your own two hands, you can bake maybe 50 loaves of bread a day. Your output is directly tied to your input. 1 hour of your time equals a set number of loaves. To grow, you could use people leverage. Hire 10 more bakers. Now you can produce 500 loaves a day. That's a 10x improvement, but you have payroll, management, and complexity. Or you could use capital leverage. Take out a loan to buy a massive industrial oven that helps your team produce 5,000 loaves a day. You've amplified your output again, but now you have debt to service.
And now let's introduce the new forms of leverage into this bakery.
Exactly. What if, instead of just selling bread, you wrote a book of your unique recipes? That book is a form of media leverage. It took you time to write it once, but it can be sold 1,000,000 times over, and you don't have to personally bake a single loaf for each sale. Or, better yet, you create a piece of software, an app, that teaches anyone in the world how to bake your bread, with interactive guides and timers. That's code leverage. You built it once, and it can be downloaded infinitely. Your knowledge is now scaling at a near zero marginal cost, reaching far more people and generating revenue completely disconnected from your personal time baking bread.
That perfectly illustrates the amplifying power. Let's look at the classic real-world example of capital leverage, real estate. It's perhaps the most common way individuals encounter leverage. Most people don't buy a house with cash. They use a mortgage. They put down, say, 20% of the home's value, and a bank finances the other 80%.
And this is where the magic and the danger happens. Let's use simple numbers. You buy a $500,000 property. You put down 20%, which is $100,000. The bank lends you the other $400,000. Now, you control a $500,000 asset with only $100,000 of your own capital. Let's say the property market does well, and over the next year, the value of the house increases by 10% to $550,000. That $50,000 gain in value is all yours. You still owe the bank $400,000, but your equity in the home has grown from $100,000 to $150,000. Your asset appreciated by 10%, but your return on your actual cash invested is 50%. That is a massive amplification.
A 5x amplification of the underlying asset's return, to be precise. That is the incredible upside of financial leverage. It allows a modest amount of equity to command a much larger asset, multiplying the returns on that equity. But this brings us directly to the pitfalls, because leverage is completely indifferent to the direction of the outcome. It magnifies gains and losses with equal force.
And this is the part that people often forget in a rising market. Let's rewind that same real estate example. You bought the $500,000 house with $100,000 down. Now imagine the market turns, and the property value falls by 10% to $450,000. The asset lost $50,000 in value. Who bears that loss? Not the bank. You still owe them $400,000. That $50,000 loss comes directly out of your equity, wiping out half of your initial investment. The property value dropped 10%, but your invested capital plummeted by 50%. This is how people get underwater on their mortgages and face financial ruin. Leverage cuts both ways, and its downward cut is brutal and swift.
This is why stress testing is so essential. Before using financial leverage, you must model the worst-case scenarios. What happens to my ability to pay the mortgage if interest rates double? What if I lose my job and my income drops for 6 months? What if the value of the asset falls 20% or 30%? If you don't have the cash reserves or the emotional fortitude to withstand that downturn without being forced to sell at the bottom, you are over-leveraged. A forced sale due to a margin call or an inability to service debt crystallizes a temporary paper loss into a permanent, devastating real loss.
The emotional toll is just as significant as the financial one. Being over-leveraged creates immense stress. Every market fluctuation becomes a source of anxiety. It clouds your judgment and leads to poor, panic-driven decisions. This applies to people leverage as well. Hiring a large team too quickly can create a massive fixed cost in salaries. If revenue dips, you're faced with the incredibly difficult decision of layoffs. The complexity of managing a large group of people can also dilute focus and slow down decision-making. It's not a simple multiplier, it's an amplifier of organizational complexity.
And the new permissionless forms of leverage have their own unique pitfalls. The very thing that makes them so attractive, their scalability and low barrier to entry, also makes them intensely competitive. When anyone can start a podcast or build an app, everyone does. The market becomes incredibly crowded and noisy. Standing out requires exceptional quality, consistency, and a deep understanding of your audience. While the financial risk might be lower, the risk of your efforts yielding zero return because you fail to gain traction is very high. You can spend years creating content or code that simply gets lost in the noise.
This leads to the strategic application of these tools. How do you use them wisely? A powerful strategy is to stack different forms of leverage, starting with the ones that have the least risk. Start with permissionless leverage. Build an audience with media. write, create videos, record a podcast, share your unique knowledge, and build a reputation. This costs you time, but very little money. The downside is capped. Once you have an audience, a group of people who trust you, you can then introduce other forms of leverage.
That audience becomes a launchpad. You can use it to launch a product, which is code leverage. Because you already have a distribution channel, your product is far more likely to succeed. With the revenue from that product, you can then apply people leverage by hiring a team to improve it and handle operations. And with a proven business model and a team, you can now approach investors for capital leverage to scale even faster. You've used one form of leverage to de-risk the next, creating a powerful growth sequence.
It's a fantastic model. You start with the thing that has a nearly infinite upside and a very limited defined downside, your time. You're building an asset, whether it's an audience or a piece of software, in a low-risk way. This is a stark contrast to the person who starts with capital leverage, taking out a huge business loan based on an unproven idea. If that idea fails, they're left with nothing but the debt. The person who starts with media and code has built a valuable asset, their reputation and their software. Even if their first commercial attempt doesn't meet expectations, they can pivot and try again with the same assets.
So the key takeaway here is to approach leverage with immense respect and a clear strategy. For financial leverage, the rule is to be conservative. Use it for productive, cash flow generating assets. A mortgage on a rental property that generates more in rent than the cost of the mortgage and upkeep is a sustainable use of leverage. A massive loan to speculate on a volatile, non-cash flowing asset is a recipe for disaster. Keep debt levels manageable, ideally where the asset's cash flow can comfortably cover the debt service even in a downturn.
And for the new forms of leverage, the key is consistency and quality. The internet is a sea of mediocrity. The only way to succeed with code or media leverage is to create something genuinely valuable and to stick with it for a long time. It's not an overnight process. Building an audience or a successful software product often takes years of consistent effort before reaching a tipping point. But once it does, the scale is unlike anything possible with traditional leverage.
It's a fundamental shift in mindset. Instead of thinking, how many hours can I work, you start thinking, how can I build a system that works for me? Leverage in all its forms is the answer to that question. It's about disconnecting your outputs from your inputs. Whether you're using money, people, or digital platforms, the goal is to create an engine that produces results that are a multiple of your own direct effort.
It is the defining characteristic of modern wealth creation. You can compound your wealth slowly and surely, and you absolutely should. But to truly accelerate the curve, you must learn to apply leverage intelligently. Start small, preferably with permissionless tools like media and code, prove your model, build an audience, create value. Then and only then should you cautiously stack on the more powerful and riskier forms of leverage like people and capital to scale what is already working.
And this idea of carefully selecting where to apply our amplified effort is a perfect bridge to our next conversation. Now that we understand how to multiply our inputs through compounding and leverage, the next logical question is, what inputs are worth multiplying? Not all ventures are created equal. Some have limited upside and massive downside, while a select few offer the reverse. This is the world of asymmetry. In our next episode, we will delve into the art and science of asymmetric opportunity selection, how to find and structure bets where a small, defined risk gives you exposure to a massive, open-ended potential reward. It's about finding the levers that have the potential to move worlds. Welcome to Wealth Building Fundamentals. In our last discussion, we explored the incredible power of leverage, how it can amplify outputs and multiply the results of our decisions. But leverage is an indiscriminate amplifier. It magnifies losses just as powerfully as it magnifies gains. That raises a critical question. What if you could find opportunities where the amplification was almost entirely one-sided? What if you could structure your bets so that the downside was known and capped, but the upside was vast and open-ended? This is the realm we're stepping into today. It's a shift from just amplifying our efforts to carefully selecting what we amplify. We're going to be talking about the principle of asymmetric opportunity selection. We'll break down what it means to seek out positive convexity, why this approach is so powerful over the long run, and how concepts like power laws dominate investment returns.
Exactly. If leverage is the engine, then asymmetric opportunity selection is the guidance system. It's what ensures the engine's power is directed towards extraordinary outcomes while protecting you from catastrophic failure. At its core, an asymmetric opportunity is one where the potential upside is significantly greater than the potential downside. The classic framing of this idea is heads I win, tails I don't lose much. Most people intuitively think about risk and reward as a balanced scale, a symmetric bet. Flipping a coin for $10 is a symmetric bet. You can win 10 or lose 10. But the most sophisticated wealth creation doesn't happen on that balanced scale. It happens when you find a scale that is deliberately, structurally tilted in your favor. This structural tilt is what we refer to as positive convexity.
That term, positive convexity, is essential here. It's a mathematical concept, but the intuition behind it is what's truly powerful. Could you elaborate on what that means in a practical sense for an investor?
Of course. In finance, convexity describes the curvature in the relationship between an asset's price and another factor, like an interest rate. A bond with positive convexity, for example, will see its price rise more from a 1% drop in interest rates than it will fall from a 1% rise in interest rates. The gains are bigger than the losses for the same magnitude of change. That's the asymmetry. When we apply this to general opportunities, we are looking for investments where positive surprises have a much greater impact on our outcome than negative surprises. The potential for gain isn't just linear, it accelerates. The most you can lose is your initial stake, a fixed amount, but the most you can gain is a large multiple of that stake. You are structuring your portfolio to benefit from volatility and randomness, not to be afraid of it.
So this strategy is less about the probability of being right and more about the magnitude of the payoff when you are right. This seems to run counter to the conventional wisdom of trying to have a high win rate.
Precisely. This is a fundamental mindset shift. The guiding principle here is that in many complex systems, especially in finance and technology, outcomes aren't governed by a normal distribution or a bell curve. They are governed by a power law distribution. A power law says that a small number of events account for the majority of the results. In venture capital, for instance, it's a well-documented phenomenon. A single successful investment in a company like Facebook or Google can return more than the entire rest of the fund combined, paying for all the other failed investments. The magnitude of that one win is what matters, not the frequency of the smaller losses. The goal is to survive the small losses long enough to capture one of those outliers.
That really clarifies the why. The expected value of a bet is skewed heavily in your favor over many trials, even if most of those trials are small losses. Let's make this concrete. What does an asymmetric opportunity look like in the real world?
The clearest textbook example is a financial instrument, the call option. When you buy a call option, you are paying a fee called a premium for the right, but not the obligation, to purchase a stock at a set price, known as the strike price, before a certain expiration date. Your downside is strictly capped. The absolute most you can lose is the premium you paid. If the stock price goes down or stays flat or doesn't rise enough, you just let the option expire worthless. You lose the premium and that's it. However, if the stock price soars, your upside is theoretically unlimited. For the small fixed price of the premium, you get exposure to all of the potential massive gains. Most options expire worthless, which means you will have many small capped losses. But one correct bet on a stock that goes up 10x or 20x can pay for all the premiums you ever spent and much more. It is a perfect structural example of positive convexity.
The auction premium is the ticket price for a chance at an exponential payoff. And it's not just in public markets. This seems to be the entire model behind early-stage venture capital investing, as you mentioned.
Absolutely. A venture capitalist builds a portfolio knowing most of their investments will fail. They might invest in 30 companies. Perhaps 20 of them will go to zero, a capped loss of their initial investment. Maybe 7 or 8 will return their initial capital, essentially breaking even. But 1 or 2 might become massive successes, returning 100x or even 1,000x their initial investment. Those 1 or 2 winners are the power law in action. They generate all of the fund's returns. The strategy is built entirely around finding and funding opportunities with this asymmetric payoff structure. It also applies outside of finance. Think about starting a business on the side. The downside is capped by the time and money you invest. The upside, if it takes off, could change your life.
This sounds incredibly powerful, but it also sounds psychologically difficult. If you're programmed to think that being wrong is bad, a strategy that involves being wrong most of the time must come with significant challenges.
It does, and this is where theory meets the messy reality of human emotion. The pitfalls are numerous and severe. The first and most common mistake is oversizing your bets. The entire principle of capped downside relies on the loss being small and survivable. If a small bet is 1 to 2% of your capital, a loss is just a cost of doing business. If you bet 25% of your capital, that capped loss is now a devastating blow that could take you out of the game entirely. You no longer have the capital to keep making bets and wait for the outlier.
So the discipline of position sizing is non-negotiable. You have to stay in the game. What other psychological traps do people fall into?
The second major trap is impatience, specifically cutting your winners too early. Because the strategy produces infrequent but massive winners, you have to let them run. Imagine you have a call option and the stock doubles. The temptation to sell and lock in 100% gain is immense. But the strategy's math only works if you capture the rare 10x or 50x move. Selling a 10-bagger after it's only a 2-bagger is a form of strategic failure. You are truncating the very power law distribution that the strategy is designed to capture.
And I imagine there's a risk of misidentifying these opportunities in the first place. You can convince yourself a bet is asymmetric when it's really just a gamble with a good story.
That's the third pitfall, narrative bias. We fall in love with a story, a revolutionary technology, a charismatic founder, and mistake that compelling narrative for a structurally asymmetric opportunity. A good story doesn't guarantee a good payoff structure. You must perform deep diligence and think in terms of base rates and probabilities. Is the downside truly capped? Is the plausible upside truly a large multiple of the risk? Many seemingly exciting opportunities are actually symmetric risks in disguise, or worse, they have negative convexity, small, steady gains with a hidden risk of catastrophic loss.
Given these challenges, how does one practically apply this? It seems to require a very specific set of rules.
It does. First, as we discussed, is strict position sizing. A common rule of thumb is to risk no more than 1 to 2% of your total investment capital on any asymmetric bet. Second is to place many independent bets. The key word is independent. The success or failure of one bet shouldn't be correlated with the others. Investing in 20 different early-stage AI companies might seem diversified, but a single regulatory change or technological shift could impact all of them simultaneously. True diversification here is about spreading bets across different ideas, industries, and structures. Finally, you should actively seek out structures that enforce the capped downside. Options do this naturally. So do staged startup investments, where you invest a small amount in a seed round with the option, but not the obligation, to invest more in future rounds if the company proves itself. This creates an asymmetric bet on the company's future.
So the key takeaway here is a radical shift in perspective. It's not about maximizing your win rate, but about engineering your wins to be so impactful that they dwarf the combined total of your frequent but small losses. It's about structuring your financial life to have a positive skew, where you survive to play another day after every loss, and only a few big wins to achieve profound success.
That's the perfect summary. It's about designing a system that makes you anti-fragile, to borrow a term from Nassim Nicholas Taleb. A system that can actually benefit from the chaos, randomness, and uncertainty of the world because your exposure to negative events is limited, while your exposure to positive events is open-ended. It requires patience, discipline, and the psychological fortitude to look wrong most of the time while you wait for the results that prove you right in the most significant way possible.
This approach seems to lay the perfect foundation for our next discussion. You can have the perfect strategy for selecting asymmetric opportunities, you can size your positions correctly, and you can understand the math of power laws, but none of it matters if you can't execute the strategy. If you panic during a string of small losses or get greedy and cut a winner short, the whole system breaks down. This all hinges on psychology.
It absolutely does. The greatest strategy in the world is useless without the mental and emotional architecture to implement it consistently. And that brings us to what we'll be discussing in our next episode, the indispensable role of discipline and emotional control in preventing our own behavioral biases from destroying our best-laid plans.
Welcome to Wealth Building Fundamentals, where we distill the timeless principles of financial growth. In our last discussion, we explored the power of asymmetric opportunities, the art of finding investments where the potential upside massively outweighs the capped downside. But identifying such an opportunity is only the first step. What happens next? What happens when the bet goes against you, when fear creeps in, or when the crowd is telling you you're wrong? This brings us to what is arguably the most critical and most difficult component of any successful wealth-building journey.
Exactly. It's the invisible architecture supporting every great investment strategy. It's the difference between knowing the path and walking the path. Today, we're diving deep into the bedrock of execution, emotional discipline and control. We'll explore what it truly means to operate by rules instead of emotions. We will unpack why this discipline is the ultimate protector of long-term compounding, discuss the psychological traps that derail even the most intelligent investors, and, most importantly, lay out a practical framework for building the unshakable discipline required to see a sound strategy through to its conclusion.
It's a crucial topic because a brilliant strategy is utterly worthless without the fortitude to execute it. The historical data is clear. Investors routinely underperform the very funds they invest in. The gap isn't a result of poor fund selection, it's a result of poor timing, driven by emotion. So let's begin by defining our terms. When we talk about discipline in the context of wealth building, what are we really talking about? Is it about suppressing emotion entirely and becoming some kind of investing robot?
That's a common misconception. It's not about being emotionless. It's about preventing emotions from becoming the primary driver of your decisions. Emotional discipline is the capacity to create a sound, logical framework for your financial decisions before you're in the heat of the moment, and then having the integrity to adhere to that framework when markets are chaotic. It means you operate by a pre-committed set of rules, not by the primal instincts of fear and greed. When the market is soaring and everyone is euphoric, discipline is what stops you from recklessly chasing performance. When the market is crashing and the prevailing sentiment is panic, discipline is what allows you to stick to your plan, whether that's holding, rebalancing, or even buying more.
So it's about building a system that functions as a buffer between your emotional impulses and your capital. It's an acknowledgement of our own inherent psychological flaws.
Precisely. The power of this approach can't be overstated. Its primary function is to preserve the engine of all wealth creation, compounding. Every time you make an emotionally driven mistake, selling in a panic, buying into a speculative frenzy, you are interrupting that compounding process. You're not just realizing a loss or buying at a peak, you are resetting the clock, forfeiting all the future growth that capital could have generated. A rule-based process is designed to prevent these forced errors. It systematically captures the long-term returns of an asset class by ensuring you are in the market to capture them, shielding you from the self-destructive cycle of buying high and selling low that plagues so many.
It sounds simple, but we know it's incredibly difficult in practice. Perhaps an analogy could help illustrate the dynamic.
Of course. Imagine two sea captains setting out on the same long voyage. The first captain is an intuitive sailor. He has no set course, relying instead on his feel for the wind and the waves. On a calm, sunny day, he makes excellent progress, and his confidence soars. But then a storm hits. The waves are terrifying, the sky is dark, and the wind is howling. Panic sets in. He starts turning the wheel erratically, first heading one way, then another, desperately trying to avoid the biggest waves. He has no anchor, no map, no compass to rely on, only his immediate fear. He is entirely at the mercy of the storm.
And his journey becomes a series of reactions with no coherent direction.
Exactly. Now consider the second captain. Before she ever left port, she spent weeks studying nautical charts, weather patterns, and the capabilities of her vessel. She charted a precise course, but she also built a detailed contingency plan. Her plan outlines exactly what to do in a calm, what to do in a headwind, and most importantly, what maneuvers to execute during a severe storm. When that same storm hits, she is undoubtedly afraid. The fear is real and visceral. But she doesn't react to the fear. She reacts to her plan. She consults her charts, she follows her predetermined storm protocols, and she keeps the ship pointed in the direction her plan dictates. The storm is just as violent for her as it is for the first captain, but she navigates through it. She understands that storms are a part of the journey, not a reason to abandon it.
The first captain is the emotional investor, tossed about by the daily noise and volatility of the market. The second is the disciplined investor, who operates from a well-designed investment policy statement.
That's the perfect way to frame it. The disciplined investor's plan accounts for the inevitability of storms. It's this framework that allows them to weather the turbulence and ultimately reach their destination, while the emotional investor is often left shipwrecked, their capital destroyed by a series of panicked decisions. We saw this play out on a global scale with near-perfect clarity during the 2008-2009 global financial crisis.
That was a true test of mettle. The entire global financial system seemed to be on the brink of collapse. The fear was palpable and, frankly, rational.
It was, and it created a massive chasm in financial outcomes. On one side, you had investors who were watching the news, seeing their portfolio values plummet by 30, 40, even 50%, and they capitulated. They sold everything, thinking they were preventing further losses. Their mantra was, "I just need to get out and stop the bleeding." By selling near the bottom in late 2008 or early 2009, they locked in devastating, life-altering losses. More tragically, they then sat on the sidelines in cash, paralyzed by fear, and missed the subsequent recovery.
A recovery that was one of the most powerful bull markets in history.
One of the most powerful in history. From the low in March 2009, the S&P 500 went on a tear for the next decade, delivering multi-100% gains. The people who sold not only solidified their losses, but also missed out on the opportunity to reclaim them and then some. On the other side of that chasm were the disciplined investors. They too felt the fear. They saw the same horrifying headlines, but their actions were governed by a plan, not by their amygdala. Their investment policy statement said, "When my stock allocation drops 10% below its target, I will rebalance by selling bonds and buying stocks." So as the market crashed, their rules forced them to buy stocks at generational lows. Others simply had a plan to invest a set amount every month, and they just kept doing it, acquiring more and more shares at cheaper and cheaper prices.
They were executing their system. Their actions were predetermined, removing the need for an emotional decision at the point of maximum fear.
And in doing so, they captured the full force of the rebound and the decade of compounding that followed. The difference in their financial outcomes 10 years later wasn't due to a difference in intelligence or the quality of the assets they owned. It was purely a difference in behavior. It was a testament to the raw power of having a disciplined process and sticking to it when it is hardest to do so.
This brings us to the core challenge. Why is this so difficult? If the logic is so clear, why do so many people fail at it? What are the specific psychological pitfalls that we need to be aware of?
We are fighting against millennia of evolution. Our brains are hardwired for survival in an environment that is very different from the modern financial markets. One of the biggest culprits is loss aversion, a concept proven by psychologists Daniel Kahneman and Amos Tversky. They showed that the pain of losing a certain amount of money is psychologically about twice as powerful as the pleasure of gaining the same amount. This means a 20% drop in your portfolio feels as bad as a 40% gain feels good. This asymmetry creates a powerful impulse to sell assets after they have fallen, simply to stop the emotional pain, even if it's the worst possible financial decision.
So our brains are coded to sell low. And what about the opposite, the fear of missing out?
That's driven by another powerful force, herd behavior or social proof. As social creatures, we are wired to find safety in numbers. When everyone around us is doing something, our instinct is to assume it's the right thing to do. In the markets, this translates to buying an asset simply because its price is going up and everyone is talking about it. You see your neighbors getting rich on a hot stock, you read euphoric headlines, and the fear of being left behind becomes overwhelming. This instinct pushes us to buy high, often just as the bubble is about to burst. So you have loss aversion driving us to sell low and herd behavior driving us to buy high, a deadly combination for compounding wealth.
And these innate biases are amplified by the modern world. The constant stream of information from financial news networks and social media creates a sense of urgency.
It creates a severe action bias. The 24/7 news cycle is designed to make you feel that you need to do something right now. Every minor economic data point is presented as a game changer. Every market wiggle is framed as the start of a new trend. This fire hose of information triggers our impulse to react. But successful investing is largely an act of patient inaction. The system is designed to make you trade, to make you react, because that generates fees and clicks. A disciplined process is your shield against this manipulation. It allows you to filter out the noise and focus on what actually matters, which are the long-term fundamentals and your own financial plan. The final major challenge is the pressure of style drift during long periods of underperformance. Even a valid, time-tested strategy will go through years of lagging the market. Sticking with a value investing strategy from 1995 to 2000, for example, was excruciatingly painful as tech stocks soared. The temptation to abandon your proven strategy right before it's about to have its day in the sun is immense.
So we've identified the enemies: loss aversion, herding, action bias, and the pressure to abandon a strategy. The crucial question is, how do we build the defenses? How does one systematically apply this and forge the necessary discipline?
It begins with externalizing the rules. You cannot rely on willpower alone in the face of a market panic. You must build a system outside of your own head. The cornerstone of this system is the Written Investment Policy Statement, or IPS. This is not a flimsy document with vague goals. It is a detailed, personal constitution for your financial life. It should explicitly define your financial goals, your time horizon, and your risk tolerance. Most critically, it must contain your strategic asset allocation. For example, 60% global equities, 30% fixed income, 10% alternatives.
And the rules for managing that allocation must be concrete.
They have to be ruthlessly specific. The IPS should state, for example, I will rebalance my portfolio back to its target allocations on June 1st of every year, or whenever any asset class deviates from its target by more than 5%. This rule is unambiguous. When your stock allocation grows to 66% of your portfolio, you don't have to wonder what to do. The IPS tells you, sell 6% of your stocks and redistribute the proceeds to your underweight assets. You are no longer making a decision. You are executing an instruction you gave your future self when you were in a calm, rational state of mind. It should also include decision triggers. What criteria must be met before you buy a new asset or sell an existing one? Writing it down transforms it from a vague idea into a concrete commitment.
Beyond the IPS, what other practical steps can be taken to reinforce this discipline?
The second key is to control your information diet. You must curate your environment to support your discipline, not challenge it. This means dramatically limiting your intake of daily financial market commentary. Stop watching the market porn channels that thrive on panic and euphoria. Unfollow the short-term traders on social media. The daily fluctuations of the market are almost entirely noise. They contain no useful signal for a long-term investor, but they are extremely effective at triggering emotional responses. Instead of checking your portfolio daily, schedule reviews. For most people, a quarterly or semi-annual review is more than sufficient. This is your scheduled time to open up your statements, compare them against your IPS, and execute any rebalancing trades that your rules require. Then you close it down and get on with your life.
It's about creating intentional friction to slow down the decision-making process and prevent impulsive action.
Exactly. You are designing a system where the default is inaction. Action is the exception, taken only when your predefined rules are triggered. This systematic, almost boring process is where true long-term outperformance is born. It's not in the brilliant, heroic market calls. It's in the quiet, consistent execution of a sensible plan over decades.
So let's bring it all together. A brilliant strategy, like the asymmetric opportunities we discussed previously, can identify a path to wealth. But that path will inevitably lead through dark forests of fear and over treacherous mountains of volatility.
And emotional discipline, codified in a written plan and reinforced by a controlled environment, is the compass and the map that ensures you stay on that path. It's the understanding that wealth isn't just an analytical game, it's a behavioral one. The greatest risk to your financial plan is not the market, it's the person you see in the mirror. Building robust systems to manage that person's emotional reactions is the most important investment you will ever make. It is the fundamental that underpins all other fundamentals.
A powerful conclusion. A strategy without discipline is merely a hopeful wish. It's the consistent execution, especially during times of stress, that ultimately separates success from failure. This commitment to a plan, this ability to operate based on rules rather than impulse, is what allows compounding to work its magic uninterrupted.
And this discipline becomes most powerful when it is applied over very long stretches of time. Sticking to your plan for 1 year is good. Sticking to it for 30 years is life-changing.
Which leads us perfectly into the topic of our next conversation. Now that we have a method for finding good bets and the discipline to stick with them, we need to understand the environment in which they flourish best: time. In our next episode, we will explore the profound power of adopting a truly long-term perspective, favoring decades-long horizons, and understanding why time in the market is vastly superior to timing the market. Welcome to Wealth Building Fundamentals, where we distill the timeless principles of growing your wealth. We've been on a journey through some of the core pillars of a sound financial strategy. And if our last discussion was about building the mental fortress required to withstand the storms of the market, today we're talking about the very ground that fortress is built upon. It's the element that separates fleeting gains from enduring wealth, the one thing that can turn a molehill of savings into a mountain of financial freedom.
Exactly. We've talked about the importance of emotional discipline, of not letting fear or greed dictate your decisions. But what's the ultimate antidote to emotional investing? It's a fundamental shift in perspective. It's about learning to see the forest for the trees, to focus on the destination rather than the bumps in the road. Today, we're diving deep into the power of a long-term perspective. We'll explore what it truly means to be a long-term investor, why this approach is so incredibly powerful, and how you can cultivate this mindset in a world that's constantly screaming for your immediate attention. We'll also look at some of the psychological traps that can derail even the most well-intentioned long-term investors.
And that's a crucial point. It's one thing to say you're a long-term investor when the market is steadily climbing, but it's another thing entirely to hold on to that conviction when everything around you seems to be in freefall. So let's start with the basics. When we talk about a long-term perspective in the context of wealth building, what are we really talking about? Is it just about holding on to your investments for a long time?
That's a part of it, of course, but it's much deeper than that. A true long-term perspective is a fundamental mindset shift. It's about anchoring your decisions not on the daily, weekly, or even monthly gyrations of the market, but on the underlying principles of value creation and compounding. It's about understanding that the stock market in the short term is a voting machine, driven by sentiment and speculation, but in the long term, it's a weighing machine, reflecting the real, tangible growth of the businesses that underpin it.
So it's about separating the signal from the noise. The daily price movements are the noise, while the long-term growth of the economy and corporate earnings is the signal.
Precisely. And this is where the power of this perspective really comes into play. Time is the most powerful ally an investor has. Over short periods, market returns can be wildly unpredictable. But as you extend your time horizon, that randomness starts to fade, and the underlying trend of economic growth begins to dominate. This is the principle of mean reversion in action. Things tend to revert to their long-term average. A stock that's been beaten down might eventually recover, and a high-flying stock might come back to earth. A long-term perspective allows you to ride out these fluctuations and benefit from the overall upward trend.
And that also ties into the concept of compounding, which we've discussed before. Compounding needs time to work its magic. A long-term perspective gives it the runway it needs.
Absolutely. Think of it like planting a tree. You don't plant a sapling and expect a mighty oak the next day. You nurture it, you give it time, and you trust in the process of growth. A long-term investment strategy is very similar. The initial growth might seem slow, almost imperceptible, but over decades, the power of compounding takes over, and that small sapling can grow into a towering tree of wealth. The key is to not get discouraged by the slow start and to resist the temptation to uproot it every time there's a storm.
That's a great analogy. It really highlights the importance of patience and trust in the process. But let's talk about some real-world examples. How has this long-term perspective played out in the real world for investors?
The most compelling example is the long-term performance of the S&P 500. If you look at any single year, you'll find periods of significant losses. But if you zoom out and look at the returns over several decades, the picture changes dramatically. The historical average annual return for the S&P 500 has been around 10%. Now, that doesn't mean you'll get 10% every year. Some years will be much higher and some will be negative. But over the long run, the average holds true.
And this is where the danger of market timing comes in. People try to jump in and out of the market to catch the highs and avoid the lows, but in reality, they often end up doing the exact opposite.
Exactly. Research has shown that missing out on just a handful of the market's best days can have a devastating impact on your long-term returns. These best days often come right after the worst days, during periods of extreme volatility. So the very moments when your emotions are screaming at you to sell are often the moments when it's most important to stay invested. A long-term perspective helps you to weather these storms and stay in the game to capture those crucial upswings.
It's a classic case of our own psychology working against us. We're wired to react to immediate threats and rewards, which is not a great trait for long-term investing. What are some of the other common pitfalls that investors face when trying to maintain a long-term perspective?
One of the biggest is the allure of the hot tip or the next big thing. We're constantly bombarded with stories of people who made a fortune overnight on some speculative investment. This can create a sense of FOMO, fear of missing out, and tempt us to abandon our long-term strategy in favor of chasing short-term gains.
The siren song of quick riches.
Precisely. And then there's the pain of volatility. It's easy to be a long-term investor when the market is going up, but when your portfolio is down 20% or 30%, it's a different story. The emotional pain of seeing your hard-earned money disappear can be overwhelming, leading to panic selling at the worst possible time.
And the constant comparison to our peers doesn't help either. If your friend is bragging about the amazing returns they're getting on some risky investment, it can be hard to stick to your own, more conservative, long-term plan.
That's a huge one. This is where having a well-defined investment plan becomes so crucial. It acts as your anchor in the storm, reminding you of your long-term goals and the strategy you've put in place to achieve them. It helps you to tune out the noise and focus on what really matters.
So let's talk about the practical application. How can our listeners cultivate and maintain this long-term perspective in their own financial lives? What are the actionable steps they can take?
One of the most effective strategies is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of what the market is doing. When the market is down, your fixed investment buys more shares, and when the market is up, it buys fewer. This takes the emotion out of the decision-making process and ensures that you're consistently investing for the long term.
It's a way to automate your discipline.
Exactly. And it's incredibly powerful when combined with broad market index funds. By investing in a diversified portfolio of stocks, you're essentially betting on the long-term growth of the entire economy rather than trying to pick individual winners and losers.
And what about rebalancing? How does that fit into a long-term strategy?
Rebalancing is a key component. Over time, some of your investments will perform better than others, causing your portfolio to drift away from your target allocation. Rebalancing involves selling some of the assets that have performed well and buying more of the assets that have underperformed. This forces you to buy low and sell high, which is the exact opposite of what our emotions tell us to do.
It's a disciplined way to manage risk and keep your portfolio aligned with your long-term goals. So, to recap, some of the key takeaways for our listeners are to focus on the long-term trend rather than short-term noise, to use strategies like dollar-cost averaging and rebalancing to automate their discipline, and to have a well-defined investment plan that acts as their guide.
That's a great summary. And I would add one more thing. Change the way you measure success. Instead of obsessing over the daily or monthly performance of your portfolio, focus on whether you're on track to meet your long-term financial goals. Are you saving enough? Is your asset allocation appropriate for your risk tolerance and time horizon? These are the questions that really matter in the long run. The journey to building wealth is a marathon, not a sprint. And just as we've discussed the importance of a long-term perspective for your investments, in our next episode, we'll delve into a foundational habit that ensures you have the capital to invest in the first place. We'll be talking about the simple yet profound principle of pay yourself first.
A crucial next step in our wealth-building journey. Thank you for that insightful discussion. And thank you to our listeners for joining us on Wealth Building Fundamentals. We'll see you next time. Welcome to Wealth Building Fundamentals. In our last discussion, we explored the immense power of adopting a long-term perspective, the discipline of looking out not just years, but decades, anchoring our financial decisions in fundamental value rather than the chaotic noise of the daily markets. It's a powerful mindset, but a mindset alone doesn't build wealth. It sets the destination, but it doesn't pave the road.
That raises the critical question, doesn't it? If we've committed to the journey, how do we ensure we're consistently making progress, day in and day out, without letting our own human fallibility get in the way? How do we translate that long-term vision into an automatic, unthinking, and relentless process of accumulation? It's one thing to say you'll stay invested for 30 years. It's another thing entirely to build the system that makes it inevitable.
Exactly. Today, we're moving from the why to the how. We are going to dissect the single most powerful mechanism for turning income into capital. This is the engine that drives the compounding vehicle we've talked so much about. We're talking about a principle called pay yourself first.
And it's a concept that sounds deceptively simple, but its implications are profound. We'll explore what it truly means to make your future self your primary creditor. We'll break down the powerful behavioral psychology that makes this strategy so effective, far more than simple budgeting. We'll look at real-world examples that prove its efficacy on a massive scale. And of course, we'll discuss the practical steps to implement it and the common pitfalls that can derail even the best intentions.
This isn't just a clever savings hack. It is a fundamental re-engineering of your financial life. It's the bridge between the long-term perspective we discussed previously and the actual tangible wealth you aim to build. Without this mechanism, a long-term view is just a wish. With it, it becomes a plan.
So let's define it clearly. Pay yourself first is the non-negotiable allocation of a fixed portion of your income to savings and investments the moment you receive it. This happens before any other bills are paid, before groceries are bought, before any discretionary spending is even considered. You are treating your wealth-building goals as the most important line item in your budget. It becomes the first and most critical bill you pay each month.
The traditional and frankly broken approach is to spend first and then save whatever is left over at the end of the month. The fatal flaw in that model is that human nature and modern life conspire to ensure there is rarely anything left over. Expenses have a way of expanding to meet income. Parkinson's law isn't just for bureaucracy, it's for personal finance too.
Paying yourself first inverts this entire process. Instead of your savings being a leftover, it's a priority. Your lifestyle and spending then adapt to the income that remains. It's a profound shift in mindset and mechanics. You are no longer trying to find money to save, you are forced to find a way to live on what's left after you've saved. It completely changes the default setting of your financial life.
And this is where its true power lies. It removes willpower from the equation. We all have finite reserves of discipline. Making dozens of correct financial decisions every single day is exhausting. Should I buy this coffee? Can I afford this subscription? Do I have enough to invest this month? This constant stream of micro-decisions leads to decision fatigue, and when we're tired, we tend to make poor choices.
Automation is the antidote to decision fatigue. By making the act of saving and investing automatic, you make one good decision that then executes itself perfectly hundreds of times without any further input. You design a system where your default action is the correct one. Your consistency is no longer dependent on how motivated you feel on any given Tuesday morning. It just happens. This automated consistency also perfectly enables the strategy of dollar-cost averaging, ensuring you are consistently buying into the market in both up and down cycles, which smooths out your purchase price over the long term.
Let's use an analogy. Think of your income as a river. The conventional approach is to let the entire river flow down to a village representing your monthly expenses. You hope that after the village has used all the water it needs, there will be a little trickle left over to divert to a reservoir for the future. More often than not, the village uses up the entire river.
The pay-yourself-first approach is fundamentally different. It's about building a dam and a pipeline right at the source of the river. The moment the water starts to flow, 15% of it is immediately and automatically diverted through that pipeline into your reservoir, your investment accounts. The remaining 85% then flows down to the village. The village never even sees the first 15%. It simply learns, by necessity, to operate on the flow it receives. And meanwhile, month after month, year after year, that reservoir is steadily, quietly, and relentlessly filling up, protected from the village's fluctuating daily needs.
That is a perfect illustration. And we see this principle validated with incredible success in the real world. Look no further than the adoption of auto-enrollment in 401k and other workplace retirement plans. For decades, companies struggled with low participation. They'd offer generous matching funds, but employees had to actively choose to sign up. They had to fill out paperwork and decide on a contribution rate. That small amount of friction was enough to prevent millions from starting.
Then came the behavioral shift to auto-enrollment. The default was changed. New employees were automatically signed up to contribute a certain percentage unless they actively chose to opt out. The results were staggering. At many firms, participation rates shot up from under 60% to over 90%. It wasn't that people suddenly became more disciplined or future-focused. The system was simply redesigned to make the correct choice the easy, automatic one.
The numbers that result from this are truly life-changing. Let's take the example from the data. Someone earning $90,000 a year who commits to a 20% savings rate, that's $18,000 per year or $1,500 per month. If that amount is invested automatically for 30 years and achieves a conservative 7% average annual return, the final sum is over $1.7 million. And that outcome is driven almost entirely by consistency and time, not by brilliant market timing or finding a secret high-growth stock. It's the process. It's the system.
And the most successful of these systems include a feature called auto-escalation. This is where the brilliance of automation compounds on itself. The system automatically increases your contribution percentage by 1% or 2% each year, often timed to coincide with annual raises. You barely feel the difference in your take-home pay because it's a small slice of your new higher income. But over a decade, your savings rate can climb from, say, 10% to 20% without you ever having to make another active decision. You are building wealth on a gradient, making progress that is both significant and painless.
Of course, as with any powerful tool, there are ways to misuse it. The most common pitfall is being overly aggressive at the start. Someone gets inspired, they've read the books, they're listening to this podcast, and they decide to go from saving 2% to saving 30% overnight. While admirable, this often creates so much strain on their monthly cash flow that it becomes unsustainable.
Exactly. It's the financial equivalent of a crash diet. It works for a week or two, but it's miserable, and eventually willpower breaks. You get a flat tire or an unexpected medical bill, and because there's no slack in your budget, the only place to pull money from is your savings. You break the system. Then a sense of failure creeps in, and the entire habit is abandoned. The key is to start at a level that is meaningful but comfortable, and then use automation to grow it over time.
Another challenge arises for those with irregular or variable income, freelancers, commission-based salespeople, small business owners. It can be difficult to commit to a fixed percentage when you don't know what your income will be next month. But the principle still holds. The tactic just needs to be adapted. Instead of a fixed dollar amount, you commit to a percentage. When a payment comes in, you immediately transfer the predetermined percentage to your investment account before the rest hits your primary checking. It requires a bit more manual discipline, but the principle of paying your future self first remains the same.
So let's talk about the concrete how-to. The first step is to choose a starting percentage. For most people, 10 to 15% of your gross pay is a fantastic and achievable starting point. If that's too much, start with 5%. The important thing is to start.
Step 2 is to automate it. If you have a workplace retirement plan like a 401k, this is simple. You log into your portal and set your contribution rate. Turn on auto-escalation if it's available. If you're saving outside of a work plan, in an IRA or a brokerage account, you can set up an automatic transfer from your checking account to your investment account for the day after your payday.
I'd go one step further, and this is a crucial detail. Don't just transfer it from your checking account. If your employer's payroll system allows it, set up a split direct deposit. Have your 15% savings portion sent directly from your paycheck to your separate investment account. Have the other 85% sent to your regular checking account. This is the gold standard. By doing this, the savings money never even touches your spending account. You remove temptation entirely. Out of sight, out of mind.
That tactic is incredibly powerful because it short-circuits a behavioral bias known as mental accounting. When all your money sits in one big pile in a checking account, it's easy to see a large balance and feel rich, making it easier to justify a splurge. You mentally earmark some for rent, some for bills, and some for investing. But under pressure, those mental walls can crumble.
Ring-fencing the money in completely separate accounts, a checking account for spending, a high-yield savings account for emergencies, a brokerage account for long-term investing, builds real, tangible walls between those pools of capital. It makes it psychologically harder to raid your investments to pay for a vacation. You are designing an environment that encourages your best behavior.
So to summarize the application, start with a sustainable rate, ideally 10 to 15%. Automate the entire process, preferably by splitting your direct deposit so the savings are invisible. Use auto-escalation to painlessly increase your rate over time. And finally, use separate accounts to create a clear and defensible line between your spending money and your investment capital.
Ultimately, pay yourself first is not an act of deprivation, it's an act of prioritization. It's the formal, systematic declaration that your future freedom and security are more important than your present discretionary wants. It builds a foundation of capital that gives you options. It's the engine that, when combined with the long-term perspective we've discussed, makes financial independence a mathematical eventuality rather than a distant dream.
It's the difference between actively driving a car every second, constantly adjusting the steering and speed, versus setting the cruise control on a long, straight highway. You make one decision, you set the system, and it carries you toward your destination reliably and efficiently, freeing up your mental energy to focus on other things, like increasing your income or enjoying the journey.
A perfectly structured system turns an ambitious goal into a simple background process. You are no longer saving money, you are a person who saves. It becomes part of your identity.
We've established the critical importance of building that automated engine to channel a portion of your income toward wealth creation. But the size and power of that engine are ultimately determined by the amount of fuel it receives. To truly accelerate the process, we need to examine the other side of the ledger.
Exactly. Having an automated savings plan is step 1. Step 2 is maximizing the surplus that feeds that plan. And that brings us to our next topic. In our next episode, we will explore what it means to live below your means, not as a painful exercise in frugality, but as a strategic and empowering choice that dramatically accelerates your path to financial freedom.
It's the difference between actively driving a car every second, constantly adjusting the steering and speed, versus setting the cruise control on a long, straight highway. You make one decision, you set the system, and it carries you toward your destination reliably and efficiently, freeing up your mental energy to focus on other things, like increasing your income or enjoying the journey.
A perfectly structured system turns an ambitious goal into a simple background process. You are no longer saving money. You are a person who saves. It becomes part of your identity.
We've established the critical importance of building that automated engine to channel a portion of your income toward wealth creation. But the size and power of that engine are ultimately determined by the amount of fuel it receives. To truly accelerate the process, we need to examine the other side of the ledger.
Exactly. Having an automated savings plan is step 1. Step 2 is maximizing the surplus that feeds that plan. And that brings us to our next topic. In our next episode, we will explore what it means to live below your means, not as a painful exercise in frugality, but as a strategic and empowering choice that dramatically accelerates your path to financial freedom.
Welcome to Wealth Building Fundamentals. We've just established the critical importance of treating your savings and investments as the first and most important bill you pay each month. But once that automatic transfer is made, a new, more subtle challenge emerges. It's the quiet, persistent pressure that dictates what happens to the rest of your income. The question isn't just if you save, but how much of a gap you can create between what you earn and what you spend.
Exactly. Paying yourself first is the mechanism, but the principle that powers that mechanism, the engine that truly drives sustainable wealth, is the discipline of intentionally living below your means. Today, we're dissecting this foundational concept. It sounds simple, almost cliché, but its power is profound. We'll explore what it truly means to create a durable surplus, why this surplus is the essential fuel for the engine of compounding we've talked so much about, and how it fundamentally redefines your relationship with money, shifting it from a source of stress to a tool for freedom. We'll also examine the psychological traps, like lifestyle creep and social comparison, that make this simple idea so difficult in practice.
These concepts are crucial because automating your savings, as we discussed last time, is only half the battle. If your expenses rise in lockstep with your income, that automated savings rate becomes a ceiling, not a floor. Mastering the art of living below your means allows you to consistently widen the gap, turning every raise and bonus into a powerful accelerator for your financial goals. It's the difference between treading water and building a powerful current that carries you toward independence.
Think of your income as a river. For many, that river flows into a lake of expenses that is exactly the same size. The water level might be high, but there's no outflow. Nothing is being channeled elsewhere to irrigate new fields or turn a water wheel. Living below your means is like building a dam with a controlled spillway. You intentionally keep the lake of your lifestyle at a manageable, sustainable level, which creates a powerful, consistent outflow. That outflow, that surplus, is the energy you can then direct to power the turbine of your investments. A small, trickling outflow won't generate much power, but a significant, steady stream can generate an enormous amount of energy over time. The goal isn't to drain the lake, it's to control its level to maximize the power you can generate from the surplus flow.
That's a fantastic way to visualize it. It's not about deprivation, it's about deliberate engineering of your cash flow. It's about ensuring there's always a powerful stream ready to be invested. So, let's break down the mechanics. The core concept is creating a durable surplus by intentionally spending less than you earn. Why is this so much more than just saving money?
Because it fundamentally alters your financial reality in two ways. First, and most obviously, that surplus is the raw material for wealth creation. Every dollar you don't spend is a dollar that can be invested. It becomes a seed that, through the magic of compounding, can grow into a tree. Without seeds, you can't plant an orchard, no matter how fertile the ground is. This surplus is the seed capital for your entire financial future. The larger and more consistent your surplus, the more seeds you can plant, and the faster your orchard grows.
And the second way?
The second, and perhaps more profound impact, is the effect it has on your financial fragility. When you live right up to the edge of your income, your financial life is brittle. A single unexpected event, a job loss, a medical emergency, a major car repair, can shatter your stability. You are completely dependent on that next paycheck. However, by intentionally maintaining a lower cost of living, you build a buffer. Your fixed costs are lower, which means the income required to maintain your life is also lower. This dramatically reduces stress and increases your optionality. You're no longer in a defensive crouch, hoping nothing goes wrong. You have room to maneuver, to take calculated risks, to leave a job you hate, or to weather a storm without panicking. You've built resilience directly into your financial structure.
This touches on a deeper idea, that you are detaching your sense of self and happiness from consumption. In a consumer-driven society, that's a radical act. The default path is to equate a rising income with a rising standard of living, measured by more expensive cars, bigger houses, and luxury goods.
It is absolutely a radical act of intentionality. It's a conscious choice to reallocate your dollars away from funding a certain image and toward funding your own freedom. You begin to see every spending decision not just for its immediate gratification, but for its opportunity cost. This $5,000 luxury vacation today, is it worth more than the $50,000 it could become in 25 years, buying you months or even years of your life back in early retirement? It's not that the answer is always no, but living below your means forces you to ask the question. You start to weigh your purchases against the cost of your freedom, and that changes everything.
Let's ground this in a concrete example. The numbers can be startling. Consider a household earning $150,000 a year. The typical path is for their expenses to slowly but surely creep up to match that income. They buy the house that the bank says they can afford, they lease 2 new cars, and their discretionary spending fills whatever is left. They might be saving a bit in their 401k, but they feel like they're on a treadmill.
Now, let's apply the principle. Imagine that same household decides to live on $120,000 instead. They create an intentional surplus of $30,000 per year. They buy a slightly smaller house or in a less expensive neighborhood, drive reliable used cars, and are more mindful of their discretionary spending. That $30,000 a year isn't just sitting there. It's being consistently invested. If we assume a reasonably conservative 8% average annual return, that surplus of $30,000 invested every year for 25 years grows to roughly $2.2 million.
$2.2 million, generated entirely from a gap created by intentional living, not from some speculative bet or a once-in-a-lifetime windfall. And that doesn't even account for income growth. If they stick to a simple rule, the effect becomes even more dramatic.
This is where the real acceleration happens. Let's introduce a practical rule, the 50-50 raise rule. Every time they get a raise or a bonus, they dedicate half of the after-tax amount to increasing their investments and use the other half to modestly improve their lifestyle. So a $10,000 raise means their annual investment contribution immediately jumps from $30,000 to $35,000, and they have an extra $5,000 to enjoy. This feels psychologically rewarding. You get both an immediate lifestyle boost and a massive long-term acceleration of your wealth. It systemizes the prevention of full lifestyle creep.
The contrast is stark. The family living on the full $150,000 ends 25 years with perhaps a modest retirement account and a lot of depreciated assets. The family that created the surplus has over $2.2 million in investments, a lower cost of living, and therefore a much lower threshold for achieving financial independence. They need less to live on, and they have a massive asset base to fund it. They've won the game. Warren Buffett is a famous example of this in the extreme. Despite his immense wealth, he has maintained a famously modest personal lifestyle for decades, not because he has to, but because he understands that the ultimate luxury is freedom, not consumption.
This all sounds straightforward, but we know it isn't easy. The primary obstacle is a phenomenon called lifestyle creep, or lifestyle inflation. It's the tendency for spending to increase as income rises. It rarely happens with one big, foolish purchase. It's 1,000 small, seemingly justifiable upgrades. You get a raise, so you decide you deserve a better car payment. You start eating out a few more times a month. You upgrade your subscriptions. Each decision in isolation feels minor, but collectively, they erode your surplus until it disappears entirely.
And this is supercharged by social comparison. We see our friends, neighbors, or colleagues buying new things, and we feel a pressure, both internal and external, to keep up. It normalizes overspending. If everyone in your circle drives a luxury car and takes exotic vacations, a more modest lifestyle can feel like a sacrifice, even when you're objectively well off. It recalibrates our definition of normal to a level that is often financially unsustainable or, at the very least, suboptimal for wealth building.
Absolutely. The antidote to social comparison is clarity on your own goals. If your goal is to impress your neighbor, you'll buy the expensive car. If your goal is to achieve financial independence in 15 years, the choice becomes very different. You have to anchor your decisions to your own timeline and your own definition of a rich life, not someone else's. However, there is also a danger on the other end of the spectrum.
Over frugality, the scarcity mindset that can lead to burnout.
Precisely. This is when someone becomes so focused on minimizing every possible expense that life becomes an exercise in deprivation. They squeeze all the joy out of the present for the sake of the future. This can be counterproductive because it's often not sustainable. Humans aren't robots. Eventually, willpower fatigues, and this extreme frugality can trigger a rebound splurge, a massive, impulsive purchase that undoes months or even years of disciplined saving. The key is balance. It's not about being cheap, it's about being intentional. Spend extravagantly on the things you truly value, and cut back ruthlessly on the things you don't.
That's where practical application comes in. To avoid getting lost in the minutiae of coupon clipping, it's about focusing your energy on the biggest wins, the big rocks, so to speak. For most people, the three largest expense categories are housing, transportation, and food. Getting these right has a disproportionately large impact on your ability to create a surplus.
Let's take housing. Choosing to buy or rent a home that costs 25% of your take-home pay instead of 35% might not feel dramatically different day to day, but that 10% difference is pure, high-octane investment fuel month after month for decades. The same goes for transportation. The cultural norm is to get a new car every few years, financed with a loan that becomes a permanent fixture in your budget. Avoiding serial car loans by buying a reliable, modest vehicle and driving it for 10 years or more can free up hundreds of dollars every single month. That's thousands of dollars a year that can be put to work.
So, the strategy is to automate the big wins. Optimize your housing and transportation decisions once, and you automatically save money every single month without any further effort or willpower. Then, apply that 50-50 rule for raises we discussed. Automatically divert half of any income increase to your investment accounts before it even has a chance to hit your checking account. This makes your savings rate grow over time without feeling like a sacrifice.
It's about designing a system where the default option is the wise one. You're not relying on day-to-day discipline to fight against a bad system. You're building a good system that makes creating a surplus almost effortless. By fixing your biggest costs at a reasonable level and automatically saving a portion of your raises, you've essentially guaranteed that your surplus will grow over time. You've made living below your means the path of least resistance.
So, the key takeaway here is that living below your means is the most direct and reliable lever you can pull to accelerate your journey to financial independence. It is not about asceticism or depriving yourself of joy. It is the opposite. It is about the intentional allocation of your resources toward what brings you lasting value and freedom.
It's a strategic trade-off. You are trading the short-term, fleeting pleasure of conspicuous consumption for the long-term, profound security and optionality that comes from financial strength. By controlling your lifestyle, you control your destiny. You decide when you work, where you work, and what you work on. That's a level of wealth that no luxury good can ever provide. It's the ultimate return on investment.
And once you have successfully engineered this surplus, once you have that consistent, powerful stream of capital flowing from your income, the next logical question becomes, what is the most intelligent way to deploy it? How do you manage the inherent risks of investing while maximizing your potential for growth?
That leads us directly into our next discussion. It's a fascinating balance. On one hand, you want to protect your hard-earned capital from catastrophic loss, which points toward broad diversification. On the other hand, to achieve outsized returns, you often need to make concentrated bets based on deep knowledge and conviction. How do you reconcile these two opposing forces?
Next time on Wealth Building Fundamentals, we will explore that very tension. We'll delve into the principle of diversification of risk, concentration of conviction, examining how to build a resilient financial core while still leaving room to capitalize on your best ideas. It's about creating a portfolio that is both safe enough to survive the unexpected and potent enough to truly thrive. Welcome to Wealth Building Fundamentals. We've spent our last session on the bedrock principle of creating a surplus, the essential fuel for any wealth-building journey. We've established that intentionally spending less than you earn is the non-negotiable first step. But that discipline immediately surfaces a critical and often polarizing question. What do you do with that surplus? How do you deploy your capital in a world of infinite choices and uncertain futures?
It's a question that cuts to the heart of investment strategy, and it presents what seems like a fundamental contradiction. On one hand, you have the age-old wisdom, don't put all your eggs in one basket. Yet on the other, you hear titans of industry proclaim that the real path to wealth is to find one golden basket and watch it like a hawk. So which is it? Prudent dispersion or focused conviction?
Exactly. This apparent paradox is what we're untangling today. We're exploring the dual-sided mandate of sophisticated investing, the diversification of risk, and the concentration of conviction. We'll break down why you need both, how they work in tandem, and why trying to do one without the other is a recipe for either stagnation or disaster.
We'll examine how diversification mathematically reduces portfolio volatility by harnessing imperfect correlations between assets. Then, we'll define what a true investment edge looks like and how it justifies a concentrated position. We'll look at how institutions and even famously concentrated investors like Warren Buffett actually use both strategies in a sophisticated dance. Finally, we'll outline a practical framework for applying this in your own portfolio, a way to build a resilient foundation while still leaving room for high-conviction ideas to drive exceptional growth.
The surplus we talked about last time is your army. Today is about strategy, how to arrange your forces for both defense and attack. Getting this balance right protects your capital from catastrophic loss, which is the only way to allow the power of compounding to truly work its magic over the long term.
Let's start with the defensive side of the coin, diversification. At its core, diversification is the process of investing in a variety of assets to reduce risk. The key here isn't just owning a lot of stuff, it's about owning different kinds of stuff that react differently to the same economic events. This is what we call owning assets with imperfect correlations.
Can you break that down further? What does imperfect correlation mean in practice?
Imagine you own two businesses. One sells umbrellas and the other sells sunglasses. When it's raining, the umbrella business thrives, but the sunglasses business suffers. When it's sunny, the opposite happens. Neither business provides a stable income on its own. Their performance is volatile. But if you own both, your total income is much more stable regardless of the weather. The two businesses are imperfectly, or in this case, negatively correlated. One zigs while the other zags. Diversification in a portfolio works the exact same way. You are combining assets like domestic stocks, international stocks, bonds, real estate, and commodities that don't all move in perfect lockstep.
So the goal isn't just to own many stocks, but to own assets that have different fundamental drivers. Owning shares in 20 different large-cap technology companies isn't true diversification, because a single piece of bad news for the tech sector could sink them all simultaneously.
Precisely. That's a common mistake. You're diversifying away from what's called unsystematic or idiosyncratic risk, the risk specific to a single company or industry. A failed product launch, a factory fire, a damaging lawsuit, these can devastate a single stock, but they won't impact a globally diversified portfolio of thousands of companies. Diversification makes these individual company blowups survivable. It systematically protects you from ruin, from that single point of failure that can wipe out years of savings. The mathematical result of this is a reduction in the portfolio's overall variance or volatility. The ride is smoother, which is critically important for allowing compounding to do its work uninterrupted by a catastrophic loss.
This is the foundation, the defensive line that should never break. But defense alone doesn't win the championship. That brings us to the other, more aggressive side of the strategy, the concentration of conviction. This feels much riskier. How does it fit into a sound wealth-building plan?
It is riskier, which is why the barrier to entry is and must be incredibly high. Concentration is the deliberate decision to allocate a meaningfully larger portion of your capital to a single investment. You only do this when you have a demonstrable, evidence-backed edge. This isn't a hunch or a hot tip. It's a deep, analytical conviction that you understand an asset's value and prospects better than the market consensus. This edge can come from a few places. It could be an informational edge. You have access to proprietary data or insights. More commonly, it's an analytical edge. You have a unique skill set to interpret public information in a superior way. Or it could be a behavioral edge. Your long-term time horizon allows you to withstand volatility that forces others to sell at the worst possible time.
So, while diversification is about admitting you don't know which specific company will succeed, concentration is about making a very bold claim that you do know, at least in a few rare cases. And if you're right, the payoff is disproportionate.
That's the power of it. By selectively concentrating in these high-conviction areas, you can potentially generate alpha, which is the excess return you earn above and beyond the market's return. A diversified index fund is designed to give you the market's return, or beta. A concentrated position is a bet that you can beat the market. But, and this is the most important part, this aggressive strategy is only viable because it's paired with a broadly diversified core. The concentrated bet can fail. And if it does, your diversified foundation ensures you live to invest another day. The concentrated portion is your offense, but it's always supported by your stalwart defense.
I think the real-world examples really illuminate this. People often point to Warren Buffett as the ultimate advocate for concentration, quoting him saying that diversification is protection against ignorance, but they often miss the nuance of how he actually structures Berkshire Hathaway.
They absolutely do. It's a fantastic example of this dual strategy in action. If you look at Berkshire Hathaway's publicly traded stock portfolio, it is famously concentrated. A huge percentage is often in just a handful of companies like Apple. This is where he exercises his profound analytical edge. But that's only one part of Berkshire. The other part is the massive collection of wholly owned operating businesses. Geico in insurance, BNSF in railroads, See's Candies, Dairy Queen, a huge energy division. These businesses are incredibly diversified across dozens of separate industries. That collection of operating companies forms an unbelievably stable, cash-gushing, diversified core. That core provides the capital and the stability that allows him to then make massive, concentrated bets in the stock market. He diversifies his risk at the enterprise level and concentrates his conviction at the equity portfolio level.
The same model is used by large institutions like university endowments or pension funds. They don't just buy a single index fund, nor do they bet everything on 5 stocks.
Not at all. A typical institutional portfolio might have a large, diversified core of global stocks and bonds that provides a baseline return. But then they will build satellite positions around it. They might overweight a sector where their investment committee has deep specialist knowledge, like biotechnology or emerging market infrastructure. They might allocate to private equity or venture capital, areas where they believe their managers have an informational and analytical edge. They are achieving excess returns, the alpha, from these concentrated satellite positions, but within a risk framework that is anchored by the stable, diversified core. It's never an all-or-nothing proposition.
This brings us to the common pitfalls. Because the stories of wild success from concentrated bets are so seductive, many investors try to skip straight to that part of the strategy. And that's where the danger lies.
It's incredibly dangerous. The most common pitfall is mistaking overconfidence for a true edge. An investor might work in the tech industry and believe that gives them a special insight into which tech stock will be the next big thing. They then proceed to put 50% of their net worth into that one stock. This isn't conviction, it's a gamble. It's confusing familiarity with expertise. We see this all the time with heavy concentration in an employer stock or a hometown bias, where people overinvest in local companies. They are taking on massive, uncompensated, idiosyncratic risk.
And on the flip side, there's the danger of what Peter Lynch famously called diversification.
Yes, diversification. This is the investor who thinks they're diversifying but is actually just making things worse. They buy 30 or 40 different mutual funds that all essentially own the same basket of large-cap U.S. stocks. They feel diversified, but they've just created a complex, expensive, and tax-inefficient closet index fund. Even worse, they dilute their best ideas. If you have 10 great ideas and 90 mediocre ones, the 90 mediocre ones will drag the performance of the 10 great ones down to average. True diversification is about owning different asset classes, not just a multitude of similar assets.
So let's distill this down into an actionable framework. How can an individual investor implement this sophisticated core satellite strategy without being an institution or Warren Buffett?
The model is surprisingly simple and accessible. The first step is to build your core. This should represent the vast majority of your investment portfolio, typically around 70 to 80%. For most people, the best way to build this core is with low-cost, globally diversified index funds. A single fund that tracks the global stock market or a simple two-fund portfolio of total US and total international stocks is a perfect, resilient foundation. This is your defense. It's designed to capture the market's return cheaply and efficiently, and it protects you from single point of failure risk.
And with that unshakable core in place, you then earn the right to play offense with the remaining 20 to 30%. This is your satellite allocation.
Exactly. This is where you can express your high conviction ideas. But this requires rigorous self-honesty. Do you truly have an edge? If you're a software engineer with 15 years of experience in cybersecurity, you might have a legitimate analytical edge in evaluating cybersecurity stocks. If you've spent a decade as a commercial real estate broker, perhaps you have an edge in evaluating local property deals. This is where you can make a concentrated bet, but it must be governed by strict rules.
What are those rules?
First, strict position sizing. No single satellite position should ever be so large that its complete failure would critically impair your financial plan. If a 5% position goes to zero, it's painful, but your 80% core means you'll be fine. If a 50% position goes to zero, it's devastating. Second, you need a predefined thesis and risk limit. Write down why you believe this is a superior investment, and more importantly, write down what would prove your thesis wrong. If that happens, you sell. This prevents a hopeful bet from turning into a blind marriage. You are not a collector. You are an investor. This disciplined, rules-based approach to the satellite portfolio is what separates professional-level concentration from amateur gambling.
So the key takeaway is that diversification and concentration are not opposing philosophies. They are two necessary components of a single robust strategy. Diversification is your shield. It's the mandatory foundation that protects you from the unpredictable and allows you to survive the inevitable storms of the market. It ensures your long-term compounding journey is never permanently derailed.
And concentration is your sword. It's an optional but powerful tool for enhancing returns. You only wield it in those rare circumstances where you have a clear, justifiable, and significant advantage. By combining a heavily fortified defensive core with a small, sharp, and skillfully handled offensive satellite, you create a portfolio that is both resilient and potent. You protect your downside while giving yourself a real opportunity for market-beating upside.
This entire structure, building the core, carefully selecting the satellites, requires a level of discipline and consistency that can be hard for any human to maintain. We get busy, we get emotional, we forget to rebalance. The best strategy in the world is useless if it isn't implemented faithfully.
That is the perfect setup for where we're heading next. Once you've designed this powerful engine for wealth creation, how do you ensure it runs consistently without your own behavioral biases getting in the way and gumming up the works? The answer is to take your hands off the wheel as much as possible. In our next episode, we will explore the immense power of automating your savings and investing, turning this entire core satellite framework from a monthly chore into an effortless default reality.
Welcome to Wealth Building Fundamentals. We've just spent time discussing the critical balance between diversifying to protect against ruin and concentrating capital where you have a genuine, evidence-backed edge. It's a sophisticated strategy, requiring discipline to avoid both the delusion of diversification and the hubris of overconcentration. But what if the greatest risk isn't a flawed allocation, but a failure to execute consistently over time?
That's the silent portfolio killer, isn't it? The missed contributions, the emotional pauses during market dips, the simple procrastination that lets cash sit idle. You can design the most elegant financial engine, but it generates no wealth if you forget to turn the key and consistently add fuel. This is precisely why today we're shifting from the what of portfolio construction to the how of execution. We're going to explore what is perhaps the most powerful behavioral finance hack available, the principle of automating your savings and investments.
Exactly. We'll dissect what we mean by a rules-based, default-driven system. We'll analyze why removing your own hands from the controls, paradoxically, gives you far greater control over your financial destiny. We will also examine the tangible, multi-million-dollar impact this can have over a career.
And, crucially, we'll expose the hidden dangers of a set and forget mindset and provide a clear, actionable framework for implementing and maintaining a robust automation strategy. This isn't about being passive, it's about being strategically, systematically active in a way that pre-commits you to your long-term goals, turning your best intentions into inevitable outcomes.
So let's start with the foundational concept. When we talk about automating savings and investing, what are we really describing?
At its core, it's the process of creating a financial ecosystem where the crucial actions of saving and investing happen automatically without requiring your active intervention for each transaction. This means setting up recurring, scheduled transfers from your checking account to your savings, brokerage, or retirement accounts. It also means establishing rules within those investment accounts so that the transferred cash is automatically invested according to a predetermined allocation. It's about building a machine that executes your financial plan by default.
And the power of this isn't just convenience, it's deeply rooted in behavioral psychology.
Absolutely. We are all susceptible to a host of cognitive biases that are detrimental to long-term wealth creation. There's present bias, the tendency to prioritize immediate gratification over long-term rewards. It's why spending feels better than saving. There's loss aversion, the psychological pain of losing money, which is about twice as powerful as the pleasure of gaining an equivalent amount. This is what causes investors to panic sell during market downturns. Automation acts as a circuit breaker for these emotional responses. By making saving and investing the default action, it bypasses the need for willpower and discipline in the moment. The decision is made once when you are calm and rational, and the system executes it relentlessly, regardless of your mood or the market's daily gyrations.
This directly enforces one of the most powerful long-term investment strategies, dollar cost averaging.
Precisely. Dollar cost averaging is the practice of investing a fixed amount of money at regular intervals, regardless of market fluctuations. When the market is down, your fixed amount buys more shares. When it's up, it buys fewer. Automation makes this happen perfectly. Without it, investors often do the opposite. They feel euphoric and pile in when prices are high, and feel fearful and stop investing or even sell when prices are low. Automation removes that disastrous temptation to time the market, an endeavor that research overwhelmingly shows is a losing game for the vast majority of investors. The system simply continues to buy, methodically, turning market volatility from a source of fear into a long-term advantage.
And technology has taken this concept even further with the rise of robo-advisors.
Yes, what started as simple automatic transfers has evolved into a fully automated portfolio management solution. Robo-advisors can extend this principle to more complex, value-adding activities, like portfolio rebalancing. If your target allocation is 60% stocks and 40% bonds, and stocks have a great year, your portfolio might drift to 70-30. A robo-advisor can be programmed to automatically sell some of the outperforming stocks and buy more bonds to return to your target. A disciplined strategy of selling high and buying low that many investors find emotionally difficult to execute manually. Some even automate advanced strategies like tax loss harvesting, systematically selling losing positions to realize a tax benefit that can be used to offset gains.
To make this more concrete, think of it like building an aqueduct.
That's a perfect analogy. You could spend your life carrying buckets of water from a river to your city. It's laborious, inconsistent, and dependent on your daily energy and discipline. Some days you might be tired or sick or simply distracted, and the city gets less water. Or you could invest the time and effort up front to engineer an aqueduct. Once built, it channels a steady, reliable flow of water to the city, day in and day out, rain or shine, with minimal ongoing effort. Financial automation is that aqueduct. The initial setup, linking accounts, defining transfer amounts, setting allocation rules, is the engineering phase. Once it's running, it ensures your financial future is being consistently nourished, protecting it from the droughts of inaction or the floods of emotional decision-making.
Let's translate that steady flow into actual numbers. The real-world impact of this seemingly simple system can be staggering.
It truly is. Consider a young professional starting their career. They set up a system to automatically contribute 15% of their salary to their retirement account. This is often done through a workplace 401k or a similar plan. On top of that, they enable a feature called auto-escalation, which automatically increases their contribution rate by 1% each year. This small annual increase is often timed to coincide with the pay raise, so it's barely noticeable in their take-home pay.
And we can't forget the employer match, which is a critical component of this automated system.
Exactly. The employer match is essentially a 100% return on investment up to a certain limit. By automating contributions, you ensure you capture that full match every single year. When you combine these three automated elements, the base contribution, the annual auto-escalation, and the employer match, over a 30 or 40-year career, the results are profound. With even moderate market returns, say in the 7 to 8% range, that automated stream of savings can compound into a portfolio worth well over $1 million, potentially even $1.5 million or more.
And the most powerful part of this is that this multi-million-dollar outcome is achieved without requiring monthly decisions, without fighting procrastination, and without any attempts to outsmart the market. It's the triumph of a well-designed system over fickle human emotion.
The behavioral research on this is incredibly clear. Studies on retirement savings plans have repeatedly shown that when employees have to actively opt into saving, participation rates are significantly lower. But when the system is changed so that employees are automatically enrolled and have to actively opt out if they don't want to participate, savings rates skyrocket. It's the power of the default. Automation makes wealth building the default setting for your financial life.
However, this powerful tool is not without its potential failures. The set-and-forget mentality can be a double-edged sword.
It certainly can. The primary pitfall is that life isn't static. You get a significant promotion or a large raise, but your automated transfer amount remains unchanged. You've just missed a golden opportunity to accelerate your wealth building by ratcheting up your savings rate. Or you experience a major life event, marriage, the birth of a child, that should trigger a fundamental review of your financial goals and your asset allocation. If your system is running on autopilot based on assumptions that are 5 years out of date, you're automating a suboptimal strategy.
This also applies to the initial setup. If the allocation you chose at the beginning was flawed, perhaps too conservative for your age or not sufficiently diversified, automation will just diligently execute that flawed plan over and over again. It's a classic garbage in, garbage out problem. The automation itself is just a tool. It has no judgment. It will mindlessly compound your mistakes just as readily as it will compound your wisdom.
And then there are the more mundane but no less damaging logistical failures. You change your primary checking account, but forget to update the dozen automatic transfers linked to it. You might not even notice for months that your investment contributions have silently stopped. Or a brokerage firm gets acquired, the account numbers change, and your transfers start failing. These small administrative cracks can halt the entire wealth-building machine if left unchecked.
So, this brings us to the most critical part: how to apply this principle effectively and safely. It's not just set and forget, but set and monitor.
Correct. The application is a two-part process: initial setup and periodic maintenance. First, the setup. The most effective time to schedule your automatic transfers is on paycheck day. The money is moved to your investment accounts before you even have a chance to see it as disposable income in your checking account. This is the digital equivalent of paying yourself first. Within your investment accounts, enable every automation feature available. Auto-invest any cash that arrives, automatically reinvest all dividends and capital gains, and, if you're comfortable with it, enable auto-escalation for your contribution rate.
And once that aqueduct is built, you need to perform regular inspections.
This is the crucial step that prevents the pitfalls we just discussed. I recommend running a semi-annual automation audit. Put it on your calendar twice a year, perhaps in January and July. During this audit, you go through a systematic checklist. First, validate the amounts. Do your contribution percentages still make sense given any changes to your income? Can you afford to increase them? Second, validate the accounts. Log into both the sending and receiving institutions and confirm that the transfers are still active and that the account details are correct. Third, review your allocation. Does your target mix of assets still align with your time horizon and risk tolerance? Does it need to be rebalanced?
The audit should also cover the less frequently changed details.
Absolutely. This is the perfect time to check your beneficiary designations. Are they up to date? Life events like marriage, divorce, or birth can make your existing beneficiaries obsolete, and this is an often overlooked detail with serious consequences. Finally, review your tax settings. Are you maximizing your contributions to tax-advantaged accounts like a 401k or an IRA? Are your investments located in the most tax-efficient accounts? For example, holding less tax-efficient assets like corporate bonds within a tax-sheltered account.
This semi-annual check-in transforms set and forget into set, verify, and optimize.
It's a system that marries the relentless discipline of a machine with the periodic oversight of a thinking, adapting human. The automation handles the day-to-day battle against inertia and emotion, while your biannual audit provides the strategic direction.
Precisely. Automation isn't about abdicating responsibility. It's about intelligently delegating execution. It frees up your mental energy from the mundane task of making monthly contributions so you can focus on the high-level strategic questions during your audits. It's the ultimate tool for ensuring that your long-term plan is not just a document you create once, but a living strategy that is consistently and relentlessly executed over decades.
So, to bring it all together, the fundamental principle here is that the most effective path to building wealth is often paved with systematic, unemotional execution. An automated system of saving and investing is your single best defense against your own worst behavioral instincts: procrastination, fear, and greed.
It ensures you are always making progress. By making saving the default, it leverages the power of inertia in your favor. It enforces the discipline of dollar-cost averaging, and when implemented correctly, it grows with you. But it requires that periodic, intelligent oversight, the automation audit, to ensure the machine you've built remains aligned with your evolving life and goals. It is the intelligent application of benign neglect.
A well-designed system is the foundation, but as we've just discussed, that system requires periodic review and adaptation. Your goals change, your income changes, and the world itself changes. This recognition that our strategies cannot be static is the perfect bridge to our next discussion.
Indeed, once you've automated the execution of your plan, the next level of optimization is ensuring the plan itself remains intelligent and relevant. Markets evolve, new financial instruments are created, tax laws change. A strategy that was optimal a decade ago might be suboptimal today.
Which is why our next episode will be dedicated to the principle of continuous learning and adaptation. We'll explore how to deliberately compound not just your money, but your knowledge and judgment. We will discuss how to build a framework for updating your beliefs and tactics based on new evidence, ensuring your financial machine isn't just running, but is running on the most effective and up-to-date software.
Welcome to Wealth Building Fundamentals, where we distill the timeless principles of sustainable financial growth. Last time, we explored the incredible power of automation, of setting up systems to ensure we save and invest consistently, removing emotion and procrastination from the equation. It's the closest thing we have to putting wealth creation on autopilot. But that raises a critical question. Is set it and forget it the complete picture? Can you truly lock in a course for 40 years and expect to reach your destination without ever looking at the map again?
That's the paradox, isn't it? The very discipline that automation instills can also breed a dangerous complacency. The world doesn't stand still. The financial markets, the tax laws, the very tools we use to invest, they are all in a constant state of flux. What was optimal advice a decade ago might be demonstrably inefficient today. This brings us to the core of our discussion, the crucial counterweight to automation, which is the principle of continuous learning and adaptation. Today, we're going to explore what it truly means to compound, not just your money, but your knowledge, why a static playbook is destined to fail over time, and most importantly, how to evolve your strategy without becoming a victim of information overload or constant counterproductive tinkering.
Exactly. We've established the engine of wealth building through automation. Now we need to talk about the person in the driver's seat. It's about developing the judgment to make small, intelligent adjustments to the course along the way. This isn't about radically changing direction every time you see a new headline. It's about deliberately and systematically upgrading your own internal software, your understanding, your toolkit, and your network, so that your financial plan remains robust and effective as the landscape changes around you.
Let's start by defining what we mean by continuous learning in this context. It's not about day trading or chasing the latest speculative craze you read about online. It is the disciplined process of compounding your knowledge base. Think of it like a pyramid. Your first piece of financial knowledge, say understanding what an index fund is, forms the base. The next piece, learning about asset allocation, rests securely on top of that. Then you learn about the role of fees, then tax efficiency. Each new piece of knowledge isn't isolated. It connects to and reinforces everything you already know, making the entire structure stronger and allowing you to build higher.
This compounding of knowledge is incredibly powerful. It builds what investors crave most: genuine conviction. When the market panics and plunges 30%, the person with a superficial understanding sells because their strategy was just something they were told to do. The person who has deeply learned why diversification works, who has studied market history and understands the nature of volatility, has the conviction to stay the course or even rebalance into the downturn. Their knowledge acts as an emotional ballast.
It's the difference between renting an idea and owning it. When you truly own the knowledge, you can act with confidence. This process also involves a crucial and often difficult skill: updating your beliefs. The financial world is littered with the ghosts of obvious truths that are no longer true. There was a time when high-fee, actively managed mutual funds were the default option for a serious investor. The evidence that has emerged over the last few decades, however, overwhelmingly supports low-cost, passive strategies for the vast majority of people. A successful learner is one who can look at new evidence and say, "My previous belief was flawed, and I need to update my approach." They are strong in their principles, like diversification, but flexible in their tactics, like switching from a costly mutual fund to a low-cost ETF that accomplishes the same goal more efficiently.
This distinction between principles and tactics is key. The principle is own a broad, diversified portfolio. The tactic is how you own it. In 1990, the best tactic might have been a specific set of mutual funds. Today, it's almost certainly a collection of low-cost ETFs. The technology of investing has evolved. Think about it. Markets themselves evolve. Products like ETFs, target date funds, or direct indexing services are invented. Tax laws change every few years, altering the calculus of how and where you should hold your assets. A static playbook, no matter how brilliant it was at its inception, will inevitably decay as its core assumptions become outdated. It's like a photograph fading in the sun.
A great analogy for this is to think of a software engineer. Imagine a brilliant programmer who learned to code in the year 2000. If they never learned any new programming languages, frameworks, or best practices after that, they would be functionally unemployable today. Their static knowledge, once valuable, has decayed to near zero. An investor who stops learning is in the exact same position. Their financial stack becomes obsolete. Beyond just knowledge, this principle extends to your network. Your network is a learning flywheel. When you surround yourself with other informed investors, professionals, and thinkers, you create an ecosystem of idea flow. You learn faster, you see opportunities you would have missed, and your assumptions get challenged by people you respect. This is another form of compounding that widens your opportunity set far beyond what you could achieve alone.
Let's make this tangible with the real-world example of an intelligent, long-term index investor. This isn't a trader. This is someone committed to the core principles of passive investing. But watch how they adapt over time. In their 20s, they start by diligently investing in an S&P 500 index fund. It's a fantastic start, but then they start reading.
Their first adaptation comes from learning about home country bias. They realize that having 100% of their equity exposure in a single country, even a powerful one like the US, is a concentrated, uncompensated risk. So they make an adjustment. They add a broad international stock market ETF to their portfolio, achieving global diversification. Their core principle hasn't changed, but their execution of it has improved.
A few years later, they read Jack Bogle's work and have an epiphany about the corrosive impact of fees. They analyze their portfolio and realize the mutual funds they started with, while decent, carry an expense ratio of 0.75%. At the same time, they see the ETF landscape has matured, and they can get virtually identical exposure for 0.05%. They make another adaptation. They transition their portfolio from higher-cost mutual funds to a selection of low-cost ETFs. This single change could add hundreds of thousands of dollars to their net worth over a lifetime.
Next, their income grows and they enter a higher tax bracket. This prompts them to learn about tax efficiency. They discover the concepts of asset location and tax loss harvesting. They adapt again. They restructure their portfolio to hold their least tax-efficient assets, like corporate bonds or actively managed funds, inside their tax-advantaged retirement accounts, like a 401k or IRA. They put their most tax-efficient assets, like broad stock market ETFs, in their taxable brokerage account. When the market has a down year, they systematically sell losing positions to realize a capital loss, which they can use to offset other gains, and then immediately buy a similar but not identical fund to maintain their market exposure.
Finally, perhaps a decade or two into their journey, they delve into the academic research from people like Eugene Fama and Kenneth French. They learn about evidence-based factors, which are characteristics of stocks that have historically been associated with higher long-term returns, such as value, size, or quality. After careful consideration, they decide to make one last incremental tweak. They slightly tilt their portfolio, perhaps dedicating 10–15% of their equity allocation to ETFs that specifically focus on these well-documented factors. They are not abandoning their core indexing strategy, they are layering a nuanced, evidence-based refinement on top of it.
Look at that entire journey. The investor's core philosophy, own the world, keep costs low, be disciplined, never wavered. But the execution became progressively more sophisticated and efficient. They didn't jump from strategy to strategy. They made a series of deliberate, incremental improvements, each one driven by new knowledge. That is the very essence of continuous learning and adaptation.
However, this path is not without its dangers. The same internet that provides access to invaluable academic papers and investor letters also unleashes a fire hose of noise, opinion, and outright bad advice. This leads to the first major pitfall: information overload and analysis paralysis. You can spend so much time consuming every blog post, every market forecast, and every podcast that you become frozen, unable to make any decision at all. Or worse, it leads to the second pitfall: strategy churn. You hear a compelling argument for one strategy on Monday and you shift your portfolio. On Thursday, you hear an even more compelling argument for the opposite approach and you churn it all back again, racking up transaction costs and taxes, never letting any single strategy work for you.
This is where overcomplexity becomes a trap. You learn about a dozen different asset classes and a dozen different factors, and you feel compelled to include all of them. Your beautifully simple, effective 3-fund portfolio balloons into a 25-fund monstrosity that you don't fully understand and can't effectively manage. The marginal benefit of adding that 12th fund is likely zero or even negative once you account for the added costs and complexity. Remember, simplicity is the ultimate sophistication. You should only add complexity if the evidence is overwhelming that it will lead to a better risk-adjusted return after costs and taxes.
And perhaps the most insidious challenge is confirmation bias. This is the natural human tendency to seek out and favor information that confirms our existing beliefs, and to ignore or discount evidence that contradicts them. If you believe a certain stock is a winner, you'll click on all the articles that say so and dismiss the critical reports as noise. This cements outdated views and prevents the very adaptation we're talking about. Overcoming it requires active effort.
So how do you apply this principle effectively and avoid those traps? The first step is to be deliberate. You must carve out dedicated time for learning. Schedule it in your calendar, just like a meeting. Reading time, Thursday, 8 to 9 p.m. And be selective about your information diet. Prioritize primary sources and timeless knowledge over fleeting commentary. Read classic books on investing. Read the annual shareholder letters from investors you admire, like Warren Buffett or Howard Marks. Go to the source of research. You don't need to read every dense academic paper, but reading the abstract and conclusion can give you the key insight.
The second tool is to keep a decision journal. This is one of the most powerful techniques for improving judgment and combating bias. When you make a significant financial decision, buying an asset, selling an asset, changing your allocation, write it down. Note the date, the specific decision, and your thesis. Why do you believe this is the right move? What are the key variables you're watching? What outcome do you expect? And, crucially, under what conditions would this thesis be proven wrong?
This practice is transformative. When you look back at your journal a year or 5 years later, you can't fool yourself with hindsight bias. You see the flaws in your original thinking with perfect clarity. You learn what types of reasoning led to good outcomes and what led to poor ones. It creates a structured feedback loop for your own judgment. It forces you to learn from your own unique experiences, both the wins and the losses.
And finally, when you do decide to adapt, make incremental, testable tweaks. Don't liquidate your entire portfolio overnight because of a new idea. If you want to incorporate a new asset class or a factor tilt, start with a small allocation. Test the thesis with a manageable portion of your capital. See how it behaves, how it impacts your overall portfolio, and how you behave in response to it. Always prefer the simple, proven path unless the evidence for a more complex addition is truly compelling and you understand it deeply.
Ultimately, the journey of building wealth is a marathon. Automation, which we discussed last time, is like having a perfect running form that ensures you are always moving forward efficiently, step after step, mile after mile. Continuous learning is like being the runner who also studies the course map, understands the weather patterns, and knows when to drink water and when to push the pace. The form gets you moving, but the intelligence and adaptation get you to the finish line faster and in better shape, especially when the course has unexpected hills or detours.
That's a perfect synthesis. The two principles are not in opposition, they are complementary forces. Automation handles the consistent execution, freeing up your mental energy to focus on the higher-level task of learning and strategic refinement. You automate the tactics so you can adapt the strategy. It's this combination that creates a truly anti-fragile, ever-improving approach to wealth creation. This commitment to bettering your own understanding and effectiveness has profound implications. It's not just about managing your own portfolio better. The more you learn and the more adaptable you become, the more effective you are in your career, in your business, and in your ability to contribute.
And that brings us to a fundamental question about where wealth truly comes from. We've talked about saving, investing, and learning, which are largely focused on managing our own resources. But the source of those resources, the very wellspring of enduring wealth in a market economy, comes from a different principle entirely. It comes from creating things of value for other people. In our next episode, we will explore this profound idea that the most sustainable path to wealth is to focus on giving more value than you take.
Welcome to the final installment of Wealth Building Fundamentals. We've journeyed through a landscape of powerful ideas, from compounding and leverage to the critical importance of continuous learning we explored in our last episode. That idea of adaptation and growth serves as a perfect foundation for today's capstone principle, the very engine that drives all sustainable financial success.
We're going to explore a concept that can feel counterintuitive in a world that often seems focused on extraction and immediate gain. We're asking a fundamental question: is the most effective path to building lasting wealth actually paved with generosity? Today, we're dissecting the principle of giving more value than you take.
It's a powerful idea. We'll examine what it means to create outsized value, not just as a philosophical ideal, but as a concrete strategic advantage. We'll look at why this approach is so potent, creating loyalty and durable competitive moats that are nearly impossible for competitors to breach.
And we'll ground this in reality. We'll analyze one of the most compelling modern examples of this principle in action and discuss the flywheel effect it generates. Of course, we'll also confront the challenges, the siren song of short-termism, and the very real difficulty of staying principled when others seem to be winning by cutting corners. Finally, we'll distill this all into actionable steps you can apply, whether you're an investor, an entrepreneur, or a professional building your career.
Exactly. Because this isn't about altruism for its own sake, though that can be a wonderful byproduct. This is about understanding the fundamental mechanics of a healthy, thriving economic system. Enduring wealth, the kind that lasts for generations, isn't captured or seized. It's earned. It accrues to those who make the pie bigger for everyone involved: their customers, their partners, their investors, and society at large. It's about shifting from a zero-sum mindset, where my gain must be your loss, to a positive-sum framework, where success is shared and mutually reinforcing.
That distinction is absolutely critical. A zero-sum transaction is a simple transfer. I sell you something for more than it cost me, and I capture the difference. My gain is your cost. A positive-sum transaction, on the other hand, creates new value. Imagine a software tool that costs you $100 a month but saves your business $1,000 a month in labor costs. You have gained $900 in net value. The software company has gained a profitable customer. Both parties are in a demonstrably better position than they were before. The transaction didn't just move money around, it created efficiency and prosperity. That is the essence of giving more value than you take.
And when you consistently operate on that principle, something incredible begins to happen. You start building intangible yet immensely valuable assets. The first is loyalty. When customers feel they are consistently getting a great deal, not just in terms of price but in overall value, they stop looking for alternatives. The mental and financial switching costs become too high. Why risk an unknown for a marginal gain when your current provider consistently exceeds expectations?
That loyalty then fuels the second asset, referrals. People are wired to share good experiences. A customer who feels they've received outsized value becomes your most effective marketing channel. They become a voluntary, passionate advocate for your product or service. This organic growth is far more resilient and cost-effective than any paid advertising campaign. It creates a groundswell of support that builds momentum.
And all of this culminates in the creation of a powerful competitive moat. Your competitors can try to copy your product, they can try to undercut your prices, but they cannot easily replicate a deep-seated reputation for delivering superior value. That reputation is an outcome of your entire system, your culture, your processes, your long-term commitment. It becomes a core part of your brand identity, insulating you from the purely price-based competition that erodes margins and commoditizes industries. When you make your customers win, you build a fortress around your business that is defended by those very same customers.
And when you make this tangible, think of it like building a well. An extractive, zero-sum approach is to find a shallow well and pump it dry as quickly as possible. You get a lot of water fast, but soon it's gone, and you have to spend resources finding a new one. The positive-sum value creation approach is to dig a deep, sustainable artesian well. It takes more initial effort, more engineering, more patience. You invest in understanding the geology, the needs of your market. But once you tap into that deep aquifer, the water flows reliably under its own pressure for a very long time. Your customers, stakeholders, and partners are all nourished by this consistent flow, and in turn, they help you maintain and protect the wellhead.
That's a perfect analogy. And perhaps no company in the modern era has engineered a more powerful artesian well than Amazon. Its entire business model is a masterclass in the principle of giving more value than you take, operationalized through what they famously call the flywheel.
It's a beautiful and devastatingly effective model. It starts with an obsessive focus on the customer experience. From the very beginning, the goal was to offer lower prices and a vast selection. These lower prices created immense value for the customer, which naturally attracted more customers to the platform. This growing stream of customers made Amazon an essential marketplace for third-party sellers who flocked to the platform to gain access to this massive audience.
And that influx of sellers dramatically increased the selection of goods available. This greater selection, in turn, made the platform even more valuable and attractive to customers. It created a self-reinforcing loop. More customers brought more sellers, which brought more selection and competition, which further drove down prices and improved the customer experience. The flywheel was beginning to spin.
But they didn't stop there. The growing scale of their operations allowed them to build out a world-class logistics and fulfillment network. This drove down their internal costs per transaction. And here is the crucial value-creating step. Instead of just pocketing all of those efficiency gains as higher profits, they passed a significant portion of them back to the customer in the form of even lower prices and faster shipping. This was the fuel that accelerated the flywheel. Each turn made the next turn easier and faster. Lower prices led to more customers, which led to more sellers, which led to greater selection and economies of scale, which led to lower costs, which led to even lower prices.
And then they layered on Amazon Prime. This was a stroke of genius. For a flat annual fee, they bundled a suite of benefits, free 2-day shipping, streaming video, music, that individually would cost far more. For the customer, the perceived value was enormous. It felt like an incredible deal. But what it did for the business was even more profound. It fundamentally altered customer behavior. Once a customer paid for Prime, they had a strong incentive to consolidate their purchases on Amazon to get their money's worth. It erected a massive barrier to exit and transformed casual shoppers into deeply loyal, high-frequency customers, pouring even more energy into spinning that flywheel. The entire system is designed so that as Amazon wins, its customers and sellers win alongside it. That is durable enterprise value built on a foundation of surplus value creation.
It's a stunning example of long-term thinking, because this path is not easy. It requires immense patience and a willingness to forego short-term profits for long-term dominance. And this brings us to the very real pitfalls of this strategy. The world, and financial markets in particular, is often obsessed with quarterly earnings. The pressure to extract value now is immense.
This is the core challenge, short-termism. A competitor might emerge who cuts corners on quality, squeezes their suppliers, and provides minimal customer service. In the short run, their profit margins might look better. They might appear more efficient to a superficial analyst. They are pumping that shallow well for all it's worth. Staying principled in that environment requires a deep conviction in your strategy and a focus on the right metrics.
And that leads to the second pitfall, under-communicating the value you create. It's not enough to create value, you have to ensure your stakeholders perceive and understand it. If a customer doesn't realize that your higher-priced product will save them double the cost in maintenance and downtime over its lifespan, they will simply choose the cheaper alternative. Value must be made visible. This is why it's crucial to measure and articulate the outcomes you deliver for your clients.
This is where application becomes so important. How do you operationalize this principle? The first step is to shift your measurement focus. Instead of only tracking internal metrics like revenue and margin, start rigorously tracking customer outcome metrics. For a software company, this could be the amount of time saved or the measurable ROI your tool provides to your clients. For a wealth manager, it's the after-tax, after-fee return and the peace of mind that comes with a sound financial plan. You need to know in quantifiable terms how much value you are delivering.
Once you are tracking that delivered value, you can begin to align your pricing with it. This doesn't necessarily mean being the cheapest. It means ensuring there is a healthy and obvious surplus of value for the customer. The goal is for the customer to always feel like they are getting the better end of the deal. This is what creates pricing power. When the value is high enough, price becomes a secondary consideration. This alignment ensures the long-term health of the relationship.
The final, and perhaps most crucial step, is to take the profits generated from these value-aligned transactions and reinvest them directly into deepening your value advantage. This is how you make the flywheel spin faster. Reinvest in research and development to make your product even better. Invest in training your team to provide even more insightful service. Invest in systems and technology to make your processes more efficient, allowing you to pass those savings back to the customer. This creates a virtuous cycle of improvement. Each investment in your capabilities widens the gap between you and your competitors, making your value proposition ever more compelling. It compounds goodwill and solidifies your market leadership.
It transforms the business from a static entity into a dynamic, evolving system for value creation. You're not just selling a product, you're building a machine that gets progressively better at solving a problem for your customers. This relentless reinvestment into the core value proposition is the ultimate defense against commoditization.
So, as we conclude this series, this principle truly ties everything together. The patience required for compounding, the strategic thinking of leverage, the calculated bets of asymmetric risk, the emotional discipline to stay the course, and the continuous learning to adapt, all of these are in service of one ultimate goal: to build something that provides immense, enduring value to others.
Exactly. Enduring wealth is rarely the result of a lucky break or a clever trick. It is the byproduct, the inevitable outcome of consistently and systematically creating more value than you take. It's about building a reputation, a network, and a business where everyone involved, customers, employees, and partners, is winning alongside you. That is the most durable and rewarding foundation for financial success. It is the core of what it means to practice wealth-building fundamentals.